Professor Srinivasan, and in this session I am going to take you through the questions which have been provided in the RTP relevant for May 23 exams. I am going to specifically take you through the questions which are relating to the derivative and foreign exchange and interest rate sections. So let's begin with question number 1. Now question number 1 is a question on security valuation. From the following information, compute the effective rate of interest per annum as well as the total cost of funds to Nirmal Limited, which is planning a commercial paper issue. So there is this company which is planning a commercial paper issue, and we are required to find out what is the effective rate of interest, that is the yield, and the total cost of funds to the issuing company. The issue price of commercial paper is 4,87,750, face value is 5 lakhs, maturity period is 3 months, and then they have given some other additional details about issue expenses. Brokerage 0.15% for 3 months, rating charges is 0.55% per annum. Now you notice something, this is per annum whereas this is for 3 months. You've got to keep this in mind when you are solving the sum. Stamp duty is 0.20% for 3 months. Now, first things first, we will first calculate the effective rate of interest per annum, or what we call as the yield. Now, how do we calculate the yield on a commercial paper? Yield is equals to, the commercial paper is going to be issued at a discount of 487,750 while the face value is 5 lakhs, right. So the amount of yield that the investor is going to earn will be 5 lakhs minus 487,750 divided by the issue price, that is 487,750 into 100, but remember this is a 3-month commercial paper, right. So we've got to annualize the yield into 12 by 3. Now if you solve this, you're going to get the yield as 10.045% or say 10.05%. Now remember, this is on a per annum basis. Now when you say per annum basis, obviously it implies that the compounding is going to take place annually. But if you are going to find the effective interest rate, considering that this is a 3-month paper, that means every 3 months you invest, you are going to earn 10.05% per annum, which means effectively for the entire period of 1 year, what is going to be the effective rate of interest? That will be effective yield will be 1 into 1 plus 0.1005 divided by 4 whole raised to 4 minus 1. Now why are we doing this? Understand, if you are going to invest it only for 3 months during the year, and if we presume that you are going to repeat this activity, that means you will repeat this activity 4 times in a year, and every time you invest you are going to earn 10.05% per annum. That means the amount that you invest for the first 3 months, the amount you receive on maturity will again be reinvested for the next 3 months, and so on for 4 times. Now although this question states that the commercial paper is only for 3 months, but if you have got to find the effective rate of interest, that is what is it that a person might earn over the entire year on a per annum basis, then we've got to presume that this amount is going to get compounded 4 times in a year, because if the period of investment is 3 months, then the compounding effect will take place 4 times in a year. So how do you find the effective rate? that is 1 into 1 plus 0.1005 divided by 4. This will give you the effective rate of interest for the 3-month period. The whole raised to 4 because it will get compounded 4 times minus 1. You solve this, you will get an effective rate of 10.435%. This is the effective yield. Now, the second part, what they are asking is, what is the total cost of funds to Nirmal Limited? Now, the way the institute has solved it is, total cost of funds on a per annum basis. Right. So, now if you look at it from the issuer company's point of view, what are the total costs it is going to incur? One is obviously the yield which it is going to offer to the investor, that obviously is the cost to the company. So, effective interest which we calculated as 10.435%. Brokerage, now brokerage is given as 0.15% for 3 months. That means for the entire year this will be into 4, that is 0.60%. Then rating charges, rating charges is of course given on a per annum basis, so 0.55, and then stamp duty, which is 0.20% for 3 months. So, for the entire year it will be into 4, 0.80%, and the sum total of this gives us a figure of 12.385%. That is the effective cost to the issuer company on a per annum basis. Now, this is how the institute has solved it. Now, there could be an alternative solution to this also. Now, what is that alternative solution? Alternatively, the first element of cost is discount. Now, what do we mean by discount? Understand, the commercial paper is going to be issued at a discount at 487,750 and it is going to be redeemed at par, that is 5 lakh. So, the difference between these two amount, that is 5 lakhs minus 487,750, that is 12,250. This is the amount of discount which is an element of cost for the company. Then brokerage. Okay. Now, brokerage, it is 0.15% for 3 months. Now, students, you have to remember one thing, that in case of debt instruments, all the elements of cost like brokerage, rating charges, stamp duty, etc. are charged on the face value. So, 0.15%, which is for 3 months of 5 lakhs. So, that is 750, and then we have rating charges. Right. Now, how much is rating charges? Rating charges is 0.55% per annum. So, this will be 0.55% of 5 lakhs into 3 by 12. That gives us 687.5, and then we have stamp duty, which is 0.20% for 3 months. So, 0.20% of 5 lakhs. which is 1000 rupees. The sum total of all this cost comes to 14,687.5. Now, this is the cost which the company is going to incur to raise money of 487,750, right? So, above cost is being incurred to raise a sum of rupees 487,750. Therefore, cost as percentage, this would be 14,687.5 upon 487,750 into 100, and since we've got to present it as an annual cost into 12 by 3, this gives us 12.045%. Now, student, this is only an alternative solution which I am suggesting. The institute has in the RTP solved it in this manner. So, I would suggest you stick to the way the institute has presented the answer. I have just given you an alternative. Sometimes this is also presented in an alternative manner, and there would be a minor difference in terms of the cost between those two methods, but I would suggest that since the institute has solved it using this method, you also stick to this.
Okay friends, so now that you have seen question number 1, now let's go to question number 2. Students, this question number 2 again is from bond valuation, right? Security valuation, bond valuation. And in this many concepts are there, like calculating current market price, calculating duration, volatility, and the impact of volatility. Very good question. And this new thing, convexity of bond. Now, of course, new as in it came suddenly in the November 2020 paper, right? And then they have repeated that same question here, right? Bond convexity. So you have to be very careful with this fourth point. So what I will be doing is, I had recorded this video on this November 20 paper for this question. I will be pulling that video and sharing it with you. Also, if you want to know more details about convexity concept as a whole, you can of course check out our convexity video on the same channel of JK Shah classes. You can search bond convexity or convexity of bond JK Shah classes. You will get my video there. You can watch that. As far as the sum is concerned, here is the sum. Hi friends, so welcome to this video where I will be discussing with you November 2020 CA final SFM paper, new syllabus, in that question number 3A. Okay, question number 3A. Children, this particular question we'll be picking and discussing now. Alright, so children, I request everyone to please first of all pause the video and read the question carefully. Start. Okay friends, I hope you all read the question. Let us now try to understand this. Point number A. The following data are available for a bond. Face value 10,000 to be redeemed at par on maturity, which means children, the redemption value is also 10,000. Coupon rate 8.5%, years to maturity 5, yield to maturity 10%. This is the YTM given to you. You are required to calculate point number 1, current market price of the bond. Children, current market price of the bond, very simple. Can I say I have to just discount the future cash inflows at the rate YTM to find the CMP? So I'll just write down here. Okay, point number A. Okay, question number 3A. Okay, question number 3A of the paper there. Okay, and in that, children, the first point they are asking you is the current market price. Okay, so CMP, children, is nothing but present value of all future cash inflows from the bond. Okay, of course discounted at the rate YTM. Can we start? So children, what is the face value of the bond? 10,000. Coupon rate is 8.5%. So 10,000 into 8.5%, 850 will become your coupon or the interest every year for the next 5 years. So I'll write down here 850 into PVAF of, what is the YTM given, children? 10%. So I'll multiply by 10%. How many years? 5 years, correct? Years to maturity is 5 years. So 5 years plus the redemption is at par, so 10,000 into discounting factor of 10% fifth year. Can we start, children? 850 into, children, PVAF of 10% 5 years is 3.790 plus 10,000 into discounting factor of 10% fifth year is 0.621. We are taking 3 decimals here, okay? So children, 850 into 3.79 m plus 10,000 into 0.621 m plus MRC, this will come to 9,431.5. okay, 9,431.5 is the current market price. Let's see what ICAI is getting. Yes, children, they are getting the same answer, 9,431.5, point number 1. Everyone clear till here? So with that, children, we complete this point number 1. Let us now go to point number 2. They're asking you the duration, Macaulay's duration. Children, duration, we will need to make a table, right? So I'll just write down here point number 2, calculation of duration. Okay, calculation of duration. What columns will we make, children? Year, cash inflow, discounting factor at the rate 10%, present value, and then year into present value, the normal table. 1, 2, 3, 4, 5. Okay, then 850, 850, 850, 850, and then 10,000, 850. As far as discounting factors are concerned, 0.909, 0.826, 0.751, 0.683, 0.621. Children, let's calculate this. Of course, will be the current market price. So 850 into 0.909 m plus, this is 772.65. Then 850 into 0.826 m plus, this is 702.1. Then 850 into 0.751 m plus, this is 638.35. Then 850 multiplied by 0.683 m plus, this is 580.55, and then 10850 into 0.621 m plus, this is 6,737.85, and then MRC, of course, is 9431.5. Now children, let's do the year into PV calculations. 1 into 772.65 m plus 2 into 702.1 m plus 3 into 638.35 m plus 4 into 580.55 m plus 5 into 6737.85 m plus MRC, this comes to 40,103.35, and therefore children, the duration, okay, the duration will be 40,103.35 divided by 9431.5. okay, if I divide by 9431.5, I get the duration as 4.25 years. I'll write down here 4.25 years. Let's check what institute is getting. Okay, yes, 4.252. we also got 4.252. big deal. Write down here 252. Same answer. Okay, so with that, children, we complete Macaulay's duration. Let's go to volatility. Children, as far as volatility is concerned, I'll write down here point number 3, volatility. It is also called as modified duration. Okay, modified duration. Macaulay's duration is the original duration. Modified duration, if they ask you, it is volatility. The formula is duration divided by 1 plus yield, correct? Your duration, children, is 4.252 years divided by, children, the YTM was 10%, so 1.10. So children, 4.252 divided by 1.1 will give you 3.865. okay, 3.865% for every 1% change in YTM, which means for every 1% change in YTM, the bond price will change by 3.865%. So yes, they also have got 3.865, point number 3. So with that, we complete point number 3. Point number 4 now, children, they're asking you convexity of the bond. Okay, convexity of the bond, children, I hope you remember the formulas. I will just show it to you here again. Okay, see, you remember this formula of convexity? Yes, convexity is equal to V plus V minus minus 2V0, the whole upon 2V0 into delta y square. So students, here please pay attention. Okay, see what they are saying, convexity of the bond, and down they are saying the YTM decreases or basically changes by 200 basis points. Children, 200 basis points means a 2% change in YTM. So for a 2% change in YTM, what will be the convexity is what we have to calculate and give. Can we start? So children, I'll just keep this formula now in front of you. Okay, and what I will do is I'll just place this sheet here and I'll write down here point number 4. Okay, point number 4, convexity, okay, is equal to, convexity is equal to, now children, do you understand that it is equal to this formula? Okay, this particular formula. But students, if you want the exact adjustment of convexity, do you understand this is the final formula? Everybody clear? So this is of course the convexity formula, but when you just apply it on the main formula here, this will give you that gap, right, between the blue and the black lines. I hope you remember that, right? So children, I'll write down here convexity is equal to, okay, V plus V minus minus 2V0, the whole divided by 2V0 into delta y square. Okay, and convexity impact, okay, convexity impact will be, children, do you understand, it will be convexity formula into delta y square. Okay, so I'll write down here convexity into delta y square. Okay, convexity into delta y square. Can we start? So for that, children, can I say we will require the V plus, the V0 and the V minus. Everyone clear? Now children, we all know V0 is at the rate 10%, right? That is the base YTM. V plus, children, 2% is the change. So do you realize at the rate 12% and this will be at the rate 8%, 2% less, right? So V plus is 10% plus 2%, that is the current market price at 12% YTM, and V minus will be the value or the current market price at 10% minus 2% YTM, that is 8%. So children, as far as V0 is concerned, we already have the V0, right? We already have the V0 as 9431.5. So I'll just write down here 9431.5. As far as V plus and V minus is concerned, we'll have to calculate them. So children, I'll just write down V plus, that is current market price at the rate 12% will be, children, of course it will be 850 into PVAF of 12% 5 years, correct, and plus 10,000 into discounting factor of 12% 5th year. Everyone clear with this? Which is equal to 850 into, now if you take 3 decimals in 12%, the PVF will be 3.604 plus 10,000 multiplied by 0.567. 12% 5th year is 0.567. So children, 850 multiplied by 3.604. Okay, 850 into 3.604 M plus 10,000 into 0.567 M plus MRC, and this will come to 8733.4. So children will write down here 8733.4. Now children, let's do for V minus. So I'll write down V minus, that is, okay, that is current market price at the rate 8%. Children, this will be again 850 into PVAF of 8% 5 years plus 10,000 into discounting factor of 8% 5th year. So children, now let's do this. So I'll write down here 850 into PVAF 8% 5 years 3 decimals will be 3.993 plus 10,000 into discounting factor 8% 5th year is 0.681. So I'll write down here 0.681. So children, 850 into 3.993 M plus 10,000 into 0.681 M plus MRC, this will come to 10,204.05. okay, 10,204.05, 10,204.05. Everyone following till here? So children, now we will get that convexity formula here. Children, V plus plus V minus means, children, can I say this will be 8733.4 plus 10,204.05 minus 2V0. V0 is 9431.5. So I'll write down 2 into 9431.5, the whole divided by 2V0 again, 2 into 9431.5. Correct, children? Here the delta of y is 2%, so I'll write down 0.02 square. Can we start? So children, let's now take the calces. In the numerator we have got 2 into 9431.5 m minus 8733.4 plus 10,204.05 m plus MRC. This is 74.45 in the numerator, and then downstairs children we have got 0.02 into equal to into 9431.5 into 2. This is 7.5452. So children, 74.45 divided by 7.5452 will give you 9.87, or for 3 decimals we can write it as 9.867. okay, 9.867. Everyone clear with this? Okay, so now children, to find out the final convexity impact, okay, convexity impact, all right, or just we can write it as convexity. Students, do you realize it will be the C multiplied by delta y square? Okay, C multiplied by delta y square. And children, to give it a percentage form, we can of course multiply by 100. So this will be 9.867 multiplied by 0.02 square into 100. So children, on the calci, 0.02 into equal to into 9.867 into 100 should give you 0.39468 or 0.395% as the convexity impact. That is the difference between the blue line and the red line. Let's see what ICAI has got, children. ICAI has also done calculations of convexity. Yes, they also got 9.867 and 0.395% as the convexity impact. Everyone clear with this? So with that children, we complete this question number 3, point number 4, and now last point is left children, point number 5. They are saying what is the expected market price if there is a decrease in the YTM by 200 basis points, which means if YTM drops to how much percent? Drops from 10% to 8%. okay, it goes down by 2%. What will be the current market price? Using the Macaulay's duration based estimate, which means using the volatility, which means using the first derivative function. Everybody clear? So using volatility, using Macaulay's duration, what is the estimate? Children, do you understand? Actually this particular point number A is nothing but the blue line. Everybody clear? And children, now they are asking you by the intrinsic value, means the actual value they are asking you, that is of course that black line. Everyone clear with this? So students, as far as the black line is concerned, we already have the answer, correct? We already have the answer here. We had calculated that at 8% children, the actual value is 10,204.05. so I'll just write down here. Okay, I'll write down here, by intrinsic value model the answer is 10,204.05. and as far as the duration model is concerned children, as far as duration model is concerned, I'll just tell you the answer in a bit. See children, what is the volatility that we have got in this particular question? In this question we have got volatility as 3.865, which means for every 1% change in YTM, correct, the bond should change by 3.865 times or 3.865%. So children, if the YTM is going to change by 2%, the bond will change by 3.865 into 2%, right? So here children, what was the original V0? What is the original price of this particular bond? It is 9431.5, right? At 10% it is 9431.5. so what I will do, I'll write down here 9431.5. now children, if the YTM at 10%, 9431.5 is the current market price. If the YTM drops by 2%, the price of the bond will increase, correct? It will increase by, children, according to the duration formula or according to the volatility, if there is a linear drop, children, what should be the drop? Children, do you understand the volatility that we have got is 3.865 for 1%. So for 2% it will be 3.865, okay, into 2. Everybody clear? Into 2% basically. So children, now 3.865 into 2, that means there should be a 7.73% jump in the bond price. So 9431.5 plus 7.73%, the answer comes to 10,000, okay, 160, 10,160.55, okay, 10,160.55. So if the bond has to lie on that straight line, the blue line, the bond price according to the first derivative function is 10,160, but in reality the convexity is there, which is why, children, do you realize it is actually 10,204. The volatility also is subject to change as the YTM changes, which is why there is that curve. So students, these are the two answers, 10,160.55 and 10,204.05. Let us check the institute solution here. Okay, now according to the institute solution, yes, they have got the same answer, 10,160.55, and children, 10,204.05 is what the answer is. And children, this, therefore they have given the expected market price is 10,204. Everyone clear with this? So with that, children, this price increased by is given to you, but that is not asked in the question, so we'll ignore it. Okay, so with that, children, we complete this question number 3 of ICEI November 20 SFM paper. I hope you understood how to solve for bond convexity. Yes, if they ask you convexity of the bond, I'll again repeat, if they ask you convexity of the bond, you have to calculate that convexity, but also the convexity impact, right, in which you do the convexity multiplied by the delta y square. Okay, so thank you very much, students. I hope you understood the entire new module of bond convexity. Thank you. Okay friends, so now that you are done with question number 2, let us now do question 3, which is from the chapter of portfolio management. Students, this is an old ICAI question. So from my online product of SFM, I will pull out my video for this question so that you can watch it and understand question number 3. Here it is. Hi friends, welcome to this video where we will be discussing one question. This is the latest ICAI question, and you know all concepts here. Concepts like return of a portfolio, risk of a portfolio, correlation calculation, X bar, sigma, all that only. Okay, I request everyone to first of all pause the video and read the question carefully. Start. Okay friends, I hope you all have read the question. Let us now try to understand it. They are saying Ramesh has identified stocks of two companies A and B having good investment potential. Following data is available for these stocks. So can you see they have given to you the market prices per share in rupees for these many years. Then they are saying you are required to calculate the risk and return by investing in stock A and stock B. So first of all, students, in order to calculate risk and return, that is sigma and X bar, we will require the percentage returns, right? Here they have given to us prices. How to convert the prices to percentage returns? You know the formula, P1 minus P0 plus D1 upon P0 into 100. Remember this, K1 is equal to P1 minus P0 plus D1, the whole upon P0 into 100. And like that for every year we will do. Here of course there is no dividend given to you, so it is just P1 minus P0 upon P0 into 100. Of course we will not be able to calculate the return for 2013 since 2012 data is not available. From 2014 onwards we can start. Are you ready? So first of all, let us calculate the returns for A and B. So I'll write down here question point number 1. In that, first of all, I'll write down step 1. Okay, step 1 would be calculation of actual returns for A and B. What formula will we use? K1 is equal to P1 minus P0 plus D1, the whole upon P0 into 100. Then let's do for A now. So I'll write down here calculation, okay, and the return. Everybody clear? Now I'll start with year 2014. Okay, so 2014. Tell me for 2014 how to calculate. It will be 18.75. Okay, 18.75 minus 19.6, correct, minus 19.6, the whole divided by 19.6 into 100. Everybody clear? The whole divided by 19.6 into 100. Let's take the calculators. 18.75 minus 19.6 divided by 19.6 into 100, and this is a negative 4.34%. Okay, negative 4.34%. Then we'll go for 2015. For 2015 it is 33.42. Okay, 33.42 minus 18.75 upon 18.75 into 100. So this is 33.42 minus 18.75 divided by 18.75 into 100, and this will give us 78.24%. Okay, 78.24%. Then for 2016, 42.64. So I'm pretty sure, children, you have understood what to do here. So what I will do is I'll just snap my finger and I'll just complete the calculation of A, and similarly I'll also do for B, right? I'll write down here calculation and also do it for B. This can be taken as A and B. I'll complete the entire calculations for you and then we'll proceed ahead. Okay students, so I've kept the entire calculation in front of you, A as well as B. So now that we have the return in percentage, let us calculate the A bar, sigma A, B bar and sigma B. Are you ready? Let's start. So we'll write down here step 2, calculation of A bar and sigma A. Okay, so for that what columns will we make? Here A and then A minus A bar the whole square. I hope you remember. How many years are there? 1, 2, 3, 4, 5, 6. Okay, so we'll take 6 years. I'll just write down 1, 2, 3, 4, 5, 6 here. 1, 2, 3, 4, 5 and 6. As far as A is concerned, it is negative 4.34. So I'll write down here negative 4.34. Next we have got 78.24. So I'll write down here 78.24. Next students, we have got 27.59. So I'll write down here 27.59. Next we have got 1.43. So we'll write down here 1.43. Next for year 5 we have got 3.12. So we'll write down here 3.12. And for year 6 we have got negative 22.09. So we'll write down here negative 22.09. Now as far as A bar is concerned, that is the expected return of A, it will minus 4.34 plus 78.24 plus 27.59 plus 1.43 plus 3.12 minus 22.09 divided by 6. We will get 13.99%. Okay, 13.99%. So with that we complete the A bar calculation. Now for sigma A. Sigma A formula is what? It is summation A minus A bar the whole square divided by N the whole under root. Let's start. So A minus A bar the whole square. So I'll take the calculator. 4.34, it's negative, so plus 13.99 into equal to M plus. 78.24 minus 13.99 into equal to M plus. 27.59 minus 13.99 into equal to M plus. 1.43 minus 13.99 into equal to M plus. Then 3.12 minus 13.99 into equal to M plus. 22.09 plus 13.99 into equal to M plus MRC, and I divide it by 6, correct, and I will get 1037.78 and I will press the root sign, and this comes to 32.21. 32.21% is the sigma A. Everybody understood A bar and sigma A. Now let's go to B bar and sigma B. We'll do it here only if you want. Okay, so I'll write down here step 3, calculation of B bar and sigma B. Okay, so for that we'll require B. and then B minus B bar the whole square. Let's start with B. As far as B is concerned, we have got 47.13, so we'll write down here 47.13. Next we have got 26.56, so we'll write down here 26.56. Third year we have got 12.65, so we'll write down here 12.65. Fourth year we have got negative 14.52, so we'll write down here negative 14.52. Fifth year we have got negative 15.06, so we'll write down here negative 15.06. And then last sixth year we have got 40.38, and I'll take here 40.38%. Ready? So now let's go to B bar. B bar will be 47.13 plus 26.56 plus 12.65 minus 14.52 minus 15.06 plus 40.38 divided by 6. We will get 16.19. So I'll write down here 16.19% as B bar. Now let's go to B minus B bar the whole square for sigma B. So sigma B of course would be under root summation B minus B bar the whole square upon n. Let's now start. Let's take the calculators. 47.13 minus 16.19 into equal to m plus 26.56 minus 16.19 into equal to m plus 12.65 minus 16.19 into equal to m plus 14.52 plus 16.19 into equal to m plus 15.06 plus 16.19 into equal to m plus 40.38 minus 16.19 into equal to m plus MRC divided by 6, and then I press root. I get 24.43. So I'll write down here 24.43%. So with that, students, we complete the calculation as far as risk and return is concerned, investing in stock A and B. Now they are asking what is the risk and return by investing in a portfolio of these stocks if we invest in stock A and B in the ratio of 6:4, which means basically 0.6 and 0.4 will be the weights. Now as far as return of portfolio is concerned, it is very simple. RP formula is what? It is WARA plus WBRB. What is the weight of A? 0.6, right? So 0.6 multiplied by return of A is 13.99. So I'll multiply by 13.99. Weight of B is 0.4 and return of B is 16.19, correct? 16.19, 16.19. So we will take the calculator. 0.6 into 13.99 m plus 0.4 into 16.19 m plus MRC, we will get 14.87%. Okay, 14.87%. So with that we complete RP. But now for sigma P, I hope you remember, we will require the correlation coefficient. See children, what is the formula of sigma P? Sigma P formula is WA square sigma A square plus WB square, correct, plus WB square sigma B square plus 2 WA WB sigma A sigma B RAB. You remember the whole under root. Now if you remember, what is the RAB formula? Can I say RAB formula is covariance AB upon sigma A into sigma B, correct? I've taught this to you in the past. Can I say RAB into sigma A into sigma B will give covariance AB? You understand this? Correct? RAB into sigma A into sigma B will give covariance AB. So students, do you therefore realize that here sigma A into sigma B into RAB, instead of writing this, we will simply write down here covariance AB to shorten the overall calculations, right? So now let's continue. Of course, you can go ahead with the RAB calculation, but the point is to calculate RAB, you have to eventually first of all calculate covariance, right? So now let's start. Now for covariance AB, what is the calculation of covariance AB? Covariance AB calculation is summation A minus A bar B minus B bar divided by N, correct? Divided by N. So what we can do here is we will have to make another table now to calculate this. Everybody clear? So let's start. I'll write here A, B, A minus A bar, this is 1, B minus B bar, this is 2, and this is 1 into 2. Everybody clear? This is 1 into 2. 1, 2, 3, 4, 5, 6. What is A? Now we have to take the numbers from here. Negative 4.34. Okay. Negative 4.34. Students, what I'll do is I'll just quickly solve this and I'll come back. Okay. So just wait. I'll snap the finger and the calculation will be ready as far as A and B numbers are concerned, and the A bar, A minus A bar, B minus B bar, multiplication, all this you know, right? So I'll just save your time. Okay students, so I have filled up the table here for you. So many questions we have done in the past for all of this. I didn't want to waste your time further. So we have got now A minus A bar into B minus B bar. The summation we have got is 96.3718, correct? This 96.3718 divided by 6, okay? So 96.3718 divided by 6, you will get 16.06 as the covariance, correct? 16.06 as the covariance. Of course, this is negative covariance, right? 16.06. So now let's place it here. WA square is 0.6 square into sigma A square. Sigma A square will be 32.21 square, correct? So into 32.21 square plus 0.4 square into sigma B square would be 24.43 square. So into 24.43 square plus 2 into 0.6 into 0.4 multiplied by negative 16.06, multiplied by negative 16.06, the whole under root. So let's take the calcium, solve this. 0.6 into equal to into 32.21 into 32.21 m plus 0.4 into equal to into 24.43 into 24.43 m plus 2 into 0.6 into 0.4 into 16.06 m minus MRC root, and this comes to 21.48%. 21.48% is your sigma of the portfolio. Everybody clear? So with that we complete the discussion to risk and return of the portfolio. Point number 3, they are saying which is the better opportunity for investment. Now as far as opportunity for investment is concerned, if you see the returns, as far as returns are concerned, A is giving 13.99, B is giving 16.19, portfolio is giving 14.87. So as far as returns are concerned, can I say security B is the best? As far as risk is concerned, can I say 32.21, 24.43 and 21.48? Between the three, of course, portfolio, because of course the negative covariance and negative correlation, eventually the sigma P is lower than A and B. So as far as risk is concerned, the portfolio is better because of lowest risk. So as far as returns are concerned, highest return who is giving? B is giving. As far as risk is concerned, lowest risk who is giving? Portfolio is giving. So it all depends on your mindset. If you are looking for more returns, go for B. If you are looking for less risk, go for the portfolio of A and B. Everyone clear? So with that we complete the discussion to this question. I hope you understood it. I'll now flash the solution of this question on your screen, so you can pause the video and copy down the notes. Thank you very much. We'll see you in the next video. Okay friends, so I hope you all have understood question number 3. Now let's go to question number 4, again from portfolio management. Again an old ICAI question. I have recorded this also in the past. I will now pull out my video from that online course of SFM and show it to you. Here is the solution to question number 4. Hello friends, so let us now see one more question, question 93. Students have picked this question from the old practice manual. Yes, I request everyone to please pause the video and read this question very carefully. Start. Okay students, I hope you all understood me. Okay students, I hope you all read the question. Let me now explain it to you. Following information is available in respect of dividends, market price and market condition after 1 year. So they're saying in this year the market condition can either be good, normal or bad. The probabilities are given to you. That means I am very sure you know what this is. 25% chance that good will happen, 50% chance normal will happen and 25% chance that bad will happen. Market prices are given to you, which means P1 can either be 115, 107 or 97. D1 can either be 9, 5 or 3. Yes, the existing market price of an equity share is 106, face value is 1, which is 10% cum bonus debenture of 6 each per share, which means they're saying that in this equity share there is also an embedded debenture there, okay, which means they're saying that this 106 if you pay, you are getting not only an equity share but also a 6 rupees worth debenture. Can I say, as far as equity share is concerned, the P0 that I will take, today's market price won't be 106, it will be purely 100 only, the value of the share alone. 6 rupees is the value of the debenture, correct? X finance company has offered the buyback of debentures at face value. Students, regarding this buyback, I'll explain later. Now let's read ahead. Find out the expected return and variability of returns of the equity share. Students, they're asking you basically X bar and sigma X. How simple this is. How many times you have done this? Can I say P1 minus 100, that is P0. I'll write down here P0 is 100, right? So P1 minus P0 plus D1, the whole upon P0 into 100 will give you X. The probability is 0.25. Then P1, that is 107 minus P0 100 plus 5D1 upon P0 into 100 will give you the other possibility of X with a probability of 0.5. Next P1, that is 97 minus P0, that is 100 plus D1 3, the whole upon P0 into 100 will give you the other possibility of X whose probability is 0.25. We have the probabilities, we have the X. Can we find X bar and sigma X, students? We have been doing this day in and day out since the time portfolio started. In fact, since the initial modules only we were doing this. So nothing much in this particular case, right? Students, what you have to only understand in this case is advice whether to accept the buyback or not. Okay, friends. So before I explain to you this buyback thing, that is this bracket here, let us first calculate the X bar and sigma X of this equity share, correct? Students, I'm very sure you understand this is P1 given to you, this is D1 given to you, and your P0 is 100, right? Not 106. Ready? So let's start. So question number 93, first part, students, calculation of X bar and sigma X, okay? Students, X bar and sigma X, for that I will need the 3 possible levels of X, correct? Students, what are the 3 market conditions? Good, normal and bad, correct? So if the market condition is good, okay, tell me what will be P1? P1 will be 115, correct? D1 will be 9. So I'll write down here P1 is 115, D1 is 9. P0 obviously is 100. Don't take the 6 rupees, correct? 6 rupees is the value of the debenture. We are only looking at the equity share. So tell me what will be my K? 115 P1 minus P0 plus D1 upon P0 into 100. 15 plus 9 is 24. This will give me 24%, correct? If the market condition, students, next is normal. If the market condition is normal, what is P1? P1, students, is 107, D1 is 5. So I'll write down P1 is 107, D1 is 5, P0 obviously is 100. So my K will be 107 P1 minus P0 plus D1 upon P0 into 100. 7 plus 5 is 12. This is 12%. Everybody following? And what if the market condition next is bad? So if the market condition is bad, my P1, students, is how much? 97, and my D1 is 3. So I'll write down P1 is 97. Yes, D1 is 3. My K will be P1 minus P0 plus D1 upon P0 into 100, which is obviously 0%, correct? So we now have the 3 possible levels of X. We have done so many questions like that, students. Ready? So we have the 3 possible levels of X, and then we have the P's also. Let us find summation Px and then the sigma X. Students, what columns will I make? P, X, Px, P, X minus X bar, the whole square, correct? What are the 3 probabilities given? 0.25, 0.50, 0.25. I'll write down here 0.25, 0.50, 0.25. The 3 levels of X are, okay, 24%, 12% and 0%, correct? So I'll write down here 24%, 12%, 0%. Let us find the X bar, that is the expected return of this security. 0.25 into 24 M plus, 0.50 into 12 M plus, and next is 0 only. So MRC, this gives me 12%, which means the share is expected to give 12% return, and the deviation, let's calculate, students. So x minus x bar the whole square into P, 24 minus 12 into 0.25 M plus, 12 minus 12 into equal to M plus, that is 0 only. Then 0 minus 12 into 0.25 M plus MRC, and then I root it, I get 8.49%, right? So sigma x comes to 8.49%, which means, students, we have x bar, expected return of the share is 12%, and the risk of the share is 8.49%. Till your story is clear. Now, students, let me show you what they are asking you next. They are saying that this company has offered buyback of debentures at face value. So what they are saying, this 6 rupees debentures is there, right? Children, what is this 6 rupees debenture? I'll explain. There is this instrument, okay? In that there is an equity component, there is a debt component. Total market value is 106, of which 6 rupees belongs to debt, 100 rupees belongs to equity. Till here everything is clear. So if an investor invests 106 in the company, do you realize the company gives him this instrument, which means with this guy, this instrument is now there, and this guy's 106 rupees is with the company. Now the company says that we wish to give back 6 rupees, you please give back the debenture proportion. Everybody following? Buy back of debentures. The company wants to buy back the debenture by paying him rupees 6. Till here everything is clear. They are asking you in the question whether to accept the buyback or not. They are saying the company has offered buyback of debentures at face value, whether you want to accept the buyback or not. Students, please let us see what ICAI is saying. It's a theory note. Let us read it, then I'll explain it to you, okay? So from the derivatives practice manual, Indian Capital Market Practice Manual, this question is there. From that particular practice manual, I've put this question in this chapter of portfolio because the probability etc. was there, and I thought it is best to teach you this sum in the portfolio chapter only, right? Students, now see what they are telling you. Now if you see, yes, 12% and 8.49% we had also got, right? That is x bar and sigma x. Don't see that now because we're already done with it. We are only going to focus on the other part. The present market price of the share is 106. Come bonus 10% debenture of 6 each. Hence the net cost is 100. There is no cash loss or any waiting for refund of debenture amount. Now this company has offered the buyback of debentures at face value. There is reasonable 10% rate of interest compared to expected return of 12% from the market. Okay, so I'm reading ahead, explanation I'll do later, okay? Considering the dividend rate and the market price, the credit worthiness of the company seems to be very good. The decision regarding buyback should be taken considering the maturity period and the opportunity in the market. Normally, if the maturity period is low, say up to 1 year, better wait, otherwise opt for buyback option. So what they are saying is that, see, you have this debenture as well as the equity share, correct? Now they are saying that from the debenture, reasonable 10% interest you're getting, correct? Where are they mentioning 10%? Can you see this? 10% reasonable interest rate you are getting, and as far as the equity share is concerned, 12% you are getting. Yes, you are getting more than the debenture in the equity, but do you realize in the equity there is a slight risk also, whereas this 10% is virtually risk-free. Everybody following? So this 10% interest rate, students, that this debenture is offering is almost risk-free. That means for zero risk you're getting 10%. On the other hand, for 8.49% risk you're getting 12%. See, 12% being higher than 8.49, it is good. I'm not saying the equity is bad, but then don't say that the debenture is also bad because it is giving you 2% less than the equity share. No, because for this 10%, do you realize no risk actually, correct? It's virtually risk-free. So they are saying, considering the dividend rate and the market rates, the credit worthiness of the company seems to be very good. Credit worthiness means the company's ability to repay the debentures, the interest on time. Okay, if the credit worthiness is low, which means we say that the default risk is high, the company might or might not give me the interest on time, it might or might not give me my principal back. That is called as low creditworthiness, high default risk. But you are considering the fact that the equity share is also giving you 12% return with only 8.49% risk, whereas without a risk it is giving you 10% return in bonds, debentures. Do you realize this creditworthiness appears nice? So they are saying the decision regarding buyback should be taken considering the maturity period and opportunity in the market. So they are saying that if you want to accept the buyback offer, accepting the buyback offer means what? I tell the company, no problem, take this debenture back that I have and give me my 6 rupees back. This should be accepted only and only taking into consideration opportunity cost outside and the maturity period. What does that mean? Opportunity cost means what? I will accept the buyback means, do you realize I will get my 6 rupees back from the company? What to do with that 6 rupees? Right now that 6 rupees is there with the company earning a 10% return without risk, correct? Now outside if you're getting something better, then you accept the buyback offer. Opportunity cost is good, accept the buyback offer. This is one way of seeing. Other way of seeing is maturity period. Let's say the maturity period of that particular debenture is 5 years. You feel that in the 5 years period the company will default, it will not give me my money back, then please accept the offer right now, accept the buyback offer right now, take the money home and you're out, your money is safe. But if you feel that in that maturity period the company will not default, then why are you accepting the buyback offer? Let the money stay with the company, you hold the debenture till the maturity. Everybody following? So normally if the maturity period is low, say up to only 1 year, better wait, otherwise opt for buyback option. So they are just giving a recommendation. They are saying that if a low maturity period is left, only few months or let's say 1 year is left, then what buyback you are doing? Let it be with the company. In 1 year at least you can understand, right, that considering the fact that today it is giving 10% in debentures, 12% in equity shares, 1 year at least it won't default. 1 year at least it won't default, right? So you let it be with the company. But if you feel that long maturity period is there, beyond 1 year if the maturity period is there and you're not able to see how much default risk is there in the company, then if you're unsure about the company, then accept the buyback offer. That's it. Nothing much in this question. Yes. So students, I hope you understood this particular question, question 93. First we analyzed the equity share alone and then we analyzed the buyback of debentures option. Yes. Thank you very much students. I will now flash the solution of this question on your screens. You can pause the video and copy down the solution. See you in the next video with another question. Thank you very much. Hello friends, so now let's do question number 5 of your RTP. This question is from the chapter of mutual funds. Now a very similar question you must have seen in the study module, but this, even though it looks similar, is not same. It's slightly different and it had come in a very recent exam also. So let's try to understand. It's a very well made question. They are saying and AMC on 1/4/2015 has floated 2 schemes, dividend plan and bonus plan. Dividend reinvestment plan and one is a bonus plan. Mr. X, an investor, has invested in both the schemes. The following details are available except the issue price. So this person, Mr. X, has purchased the units on 1/4/15 and is expected or is basically going to be holding it for 5 years, that is from 1/4/15 to 31/3. All data is available about when the dividends were given, when the bonus was issued, but what is not available is the issue price. The NAV on 1/4/2015 is not given, that is the price on which Mr. X would have purchased these units. Then there are additional details given. This is of course for the dividend plan and this is for the bonus plan. You are required to calculate the issue price of both schemes on 1/4/15. Basically find the NAV as on that date. Let's start. First of all, here we are going to assume that the face value per unit is 10. Now the face value per unit doesn't mean the issue price here also would be 10. That's a thing to be seen in this question. Let's see at what price it was issued. So first of all, let us tackle the dividend reinvestment plan. So I'll write here question number 5. I'll write here point number 1, dividend reinvestment plan. Now let's understand the data first of all. In the data they have given to you that your investment value on 1/4/2015 was 9,20,000. So I'll write here investment value on 1/4/2015 was how much? 9,20,000. Then they are telling you average profit. Now students, average profit is given to you in rupees. This is of course on per annum basis over the last 5 years. So average profit per annum is 27,748.6. So I'll write here average profit per annum is 27,748.6. Everyone there? Can I say with this, if I simply multiply this by 5, I will get the total profit over the last 5 years. So can I say total profit would be 27,748.6 into 5. We'll take the calci, 27,748.6 into 5, and that comes to 1,38,743. Now students, when we refer to profit here, we are basically referring to the appreciation in the value of units. Everyone clear till here? Including the additional units we got. So point is, over the last 5 years, total appreciation we experienced is 138,743. Considering the fact that we had invested 9,20,000, can I say value of investment on the last date, that is 31/3/2020, correct? 31/3/2020 will be 9,20,000 plus 1,38,743. Everyone clear? Plus 138,743. So we take the calci, 9,20,000 plus 138,743. This comes to 10,58,743. Everyone clear till here? So basically the value of our investment on 31/3/2020 must be, or is basically 10,58,743. Till here story clear? Now students, let us try to figure out how to find this. Using the data what we already had, whatever we could find, we found. Now can I say we have to use this data and figure out how to reach this particular number here. So I'm now going to draw one table here for you. See, please pay attention. I'll write date, okay, then I will write opening units, then I will write face value at the rate 10 rupees per unit. I will then write the dividend percentage, then I will write dividend in rupees, then I will write NAV per unit, then I will write additional units received, and then I will write closing units. Let's understand. We started our journey on 1/4/2015. Then the relevant dates that we will be picking up in this calculation in part 1 will be of course those dates where dividends were announced. Can I say that is the next one is 31/3/2017. So I'll write here 31/3/2017, on which a dividend of 12% was announced. The next date is 31/3/2018. So I'll write here 31/3/2018, on which a dividend of 10% was announced. Then we will write the next date is 31/3/2019, on which, okay, I'll just write here 31/3/2019, on which a dividend of 15% was announced. And then of course we'll write the last date, that is 31/3/2020, the last date of your investment. I'll write here 31/3/2020, but of course on this date no dividend was announced. Everyone clear till here? Great. Now we know the NAVs also. We know the NAV on 31/3/2017 is 48. So I will write 48 here. We know the NAV on 31/3/2018 is 50. So we will write 50 here. We know the NAV on 31/3/2019 is 45. We'll write 45 here. And we know the NAV on 31/3/2020 is 49. We'll write 49 here. Now, try to understand. We know that the NAV on 31/3/2020 is 49. We also know that the total value of our investment on 31/3/2020 is 10,58,743. So do you realize, therefore closing units on 31/3/2020 would be 10,58,743. Okay, I'll write here 10,58,743 divided by, okay, divided by 49. Everyone clear? Divided by 49, that will give you the number of units, right? Because 49 is the NAV per unit. 10,58,743 is the total value. If you divide, you'll get the number of units. So this 10,58,743 divided by 49, if we do, we will get 21,607 units. Now students, 21,607 units will be the closing units. So I'll write here 21,607. Everyone following? Now the best part here is on 31/3/2020 there was no dividend issued, there was no dividend in rupees, and therefore these dividends, which when get reinvested, give you additional units in a dividend reinvestment plan. But if dividend only was not there, can I say additional units also received must be 0, which therefore makes us realize that the opening units also must be 21,607 only, and of course the face value of this must be 216,070. Everyone clear till here? The closing and the opening units on 31/3/2020 is same, that is 21,607. And therefore, the closing units for 31/3/2019 will be taken as 21,607. Everybody clear till here? Now students, let us try figuring out the details for the date of 31/3/2019. So the most important detail that I need actually are the opening units. Because once I get the opening units for 31/3/2019, that will become closing for 31/3/2018, and like that will keep going up. So what I will do is, I'll write here calculation of opening units for 31/3/2019. Let it be X. Okay, so let the opening units on 31/3/2019 be X. So what I will do is, I will write this as X. Students, do you therefore realize that the face value of these units must be 10X? Everyone there with me? 10 rupees is the face value per unit. So the face value of X units will be 10X. Now if dividend announced on that date is 15%, of course, of the face value, the dividend in rupees will be 10X into 15%, that is 1.5X. Everyone clear? So what I will do is, I'll write here, okay, I'll write here dividend on 31/3/2019 will be X into 10 into 15%, which is equal to 1.5X. Now what is the NAV on that date? The NAV on that date is rupees 45. So I'll write here NAV is rupees 45. So therefore, can I say additional units received, okay, must be, right, the additional units received must be 1.5x total dividend divided by 45. These many additional units you will be getting. Story clear till here? Can I say therefore the closing units, okay, the closing units on 31/3/2019 must be, already you have opening units as X, right? Already you have opening units as X. This X plus 1.5x by 45, do you realize will be closing units? And I hope you also realize that we already know that the closing units are going to be 21,607. I think we can easily solve this and find X. So do you realize X plus 1.5x divided by 45 will be equal to 21,607. Correct? Now if you solve this, okay, we will get 45x plus 1.5x is equal to 21,607 into 45, that is 972,315. Therefore X will be 972,315 divided by 46.5, and that comes to 20,910. So what is 20,910? Opening units on 31/3/2019. So I will write here 20,910. The face value will become 209,100. Everyone clear? And then of course into 15%, the dividend here will be 209,100 into 15%. and this basically comes to 209100 into 15%. I'll do it once more. This comes to 31,365. So I'll write here 31,365, which when divided by rupees 45, okay, when divided by 45 will give you 697 as the additional units, which when added to 2910 will become 21607. Everyone understood everything about 31/3/2019? Great. Now let's go to 31/3/2018 using the same pattern. Students, first of all, the opening units of 31/3/19 will become the closing units of 31/3/18. So I'll write here 20,910. Right? Now let's find this. So let the opening units here be X. Everyone ready? So I'll write here calculation of opening units for 31/3/2018. So calculation of opening units for 31/3/2018, let it be X. Everyone clear? Now students, once you have that, can I say we can easily find the dividend of that particular date, considering 10% to be the dividend. Do you realize we will do same calculation, X into 10, but now into 10%, right? So the dividend on 31/3/2018 will be X, right? Units into 10 rupees face value into 10%. So that of course comes to end of the day X again. So the dividend that you will be receiving on 31/3/2018 is X. The NAV on that date, is 50. So I'll write here NAV is 50. So can I say the additional units that we must be receiving would be X upon 50, because X is the total dividend, 50 is the NAV per unit. So X upon 50 additional units received on dividend reinvestment. So can I say the closing units here would be X plus X by 50. X is the opening units plus X by 50 additional units. You already have the closing units as 20,910, correct? So what will we do is we will say 20,910 is equal to X plus X by 50. I hope you are understanding now. Or if you want to follow the same LHS RHS as the last time, we can understand that X plus X by 50 is 20,910. Same thing, I hope you understand. So 50X plus X is equal to 20,910 into 50, and that comes to 1045500. So can I say X will be equal to this number divided by 51, and that comes to 20,500 units. So we'll fill up the table now. So we got the opening units here as 20,500 into 10 will make it 2,05,000 into 10% dividend will again bring it back to 20,500. 20,500 divided by 50, if we do, the additional units getting received here are 410, which make the closing units as 20,910. Then we take this 20,500 opening units of 31/3/18, and that becomes the closing units on 31/3/2017. So that is 20,500. Now let's solve for 31/3/2017. So I'll write here calculation of opening units for 31/3/2017, let it be X. First of all, we'll calculate the dividend of that particular date. Students, it is 12%. So what we will be writing is dividend on 31/3/2017 will be X into 10 into 12%, and that makes it 1.2X. The NAV on that date, okay, the NAV on that date is 48. So we will write here 48. Therefore, the additional units received must be 1.2x divided by 48. Everyone making sense, right? The closing units would be opening plus the additional units. We already know the closing units have to be 20,500. So can I say we can write here x plus 1.2x upon 48 is equal to 20,500, right? So 48x plus 1.2x will be 20,500 into 48, and that comes to 9,84,000. Therefore x will be 9,84,000 divided by 49.2, and that comes to 20,000 units as the opening for 31/3/2017. So this is 20,000 units. This will become 2 lakhs. The dividend is 12%, so basically 24,000 will be the dividend here. 24,000 divided by 48, right? We will be getting 500 units additional, and that tallies everything, correct? Now the closing units on 1/4/15 would be 20,000, and since there isn't any dividend offered on 1/4/15, correct, do you realize the opening units also must be 20,000 since no additional units were issued on that particular date? Everyone clear till here? So now we know that on 1/4/15, when we must have purchased units here, we must have total purchased 20,000 units, correct? And our investment value on that date is 9,20,000. We got it. Do you understand here that therefore the NAV or the issue price, do you realize, would be 9,20,000 what we issued divided by 20,000. We take the calci, 9,20,000 divided by 20, we get the NAV or the issue price on 1/4/15 as rupees 46. Everyone clear? We get it as rupees 46. So with that, students, we get the answer of the issue price or the NAV on 1/4/2015 for the dividend plan. So now we'll go to the second plan, that is the bonus plan. So I'll write here point number 2, bonus plan. Now let's see what data they have given about bonus plan. They are saying that the investment, of course, on 1/4/2015 is rupees 10 lakh. So I'll write here investment on 1/4/2015 is rupees 10 lakhs. What else have they said? Average yield as a percentage, of course, per annum for the last 5 years is 6.4%. So I'll write here average yield as a percentage on a per annum basis is 6.4%. So can I say we can calculate the profit for the last 5 years? So profit for last 5 years will be 10 lakh into 6.4% per annum into 5 years, because 6.4 is per annum average, right, over 5 years. So I'll take the calci, 10 lakh into 6.4% into 5, and this comes to 3,20,000, which means, students, do you realize that the value of investment on the last date, that is 31/3/2020, 31/3/2020 must be 10 lakh plus the profit 320 that we earned, it must be 13,20,000. Everyone clear till here? And the NAV on that date in the bonus plan was 44. So NAV on 31/3/2020 was 44. So do you realize the closing units that we must have held on 31/3/2020 must be 13,20,000 divided by 44, and that comes to 30,000 units. Everybody clear till here? 30,000 units. Now students, let us decipher the bonus plan. Now what column should I make? I'll write date, I'll write opening units, I'll write bonus issue, I'll write bonus units, and then I'll write closing units. Okay, let me explain. First of all, what date did you invest? 1/4/2015, correct? Then the bonus was issued on 31/12/2016. So I'll write here 31/12/2016, on which date the bonus given was 1:4, which means for 4 held, 1 bonus unit. So I'll write here 1:4. The next bonus was given on 31/12/18. So I'll write here 31/12/18. Okay, and here the ratio is 1:5. So I'll write here 1:5, and then the last date, that is 31/3/2020. So I'll write here 31/3/2020. Now students, on 31/3/2020 the closing units, as we know, are 30,000. On this particular date no bonus issue was there, so no bonus units must have been received, so the opening units also must be 30, which means the closing units on 31/12/18 must be 30,000. Now students, we have to figure out how many bonus units we must have got and what were the opening units. So students, let the opening units on 31/12/18 be X. So what I will do is, I'll say calculation of number of units on 31/12/18, let it be X. Everyone clear? So students, do you realize is that if for 5 that you are holding, you will be getting 1. So if for X you are holding, you will be, can I say, getting 1/5 into X. Everyone clear? So what I will do is, since the bonus issue is 1:5, can I say number of bonus units would be as follows, that for 5 held, if we are going to get 1, then for X held at the start of that date, how many bonus units will you be getting? It is nothing but 1/5 into X, or basically X into 1/5. So I'll write X into 1/5, that is nothing but X upon 5. Everyone clear? So basically X upon 5 are the bonus units that you will be getting on 31/12/18. So do you realize that the closing units here would be opening units plus the bonus units, and we already know that the closing units are going to be 30,000. So do you realize that X plus X by 5, that is closing units total, should total to 30,000, right? So can I say 5X plus X would be equal to 30,000 into 5, that is 1,50,000. Can I say X would be 1,50,000 divided by 6, and that comes to 25,000 units. Everybody clear? 25,000 units. So that 25,000 units, do you realize, would be the opening units, correct? The opening units for 31/12/18, and 25,000 divided by 5 into 1, 5,000 would be the bonus units for that particular date, which makes the closing as 30. Now going to the previous date, can I say 31/12/16, the closing units would be 25,000. Let the opening units be X, and I hope you realize that the bonus units here would be X by 4, considering the fact that 1:4 is the ratio. So I'll write here, okay, calculation of opening units for 31/12/16, right? 31/12/16. So I'll write here 31/12/16, let it be X. The bonus issue is 1:4, correct? The bonus issue is 1:4. So can I say the bonus units would be X upon 4 or X into 1/4? So can I say the closing units would be X plus X by 4? We already know the closing units to be 25,000 for that particular date. So I'll write here, therefore X plus X by 4 is equal to 25,000. Can I say therefore 4X plus X will be equal to 25,000 into 4, that is 1 lakh, and therefore can I say X will be 1 lakh divided by 5, that is 20,000 units. Everyone clear? So what I will do here is, here the opening units on 31/3/2016 are 20,000, and then 20,000 divided by 4 into 1, again 5,000 bonus units we must have got on 31/12/2016. Now students, moving forward, can I say 31/12/16 opening units 20 will become closing units for 1/4/15. No bonus issue here, no bonus units. So can I say opening units must be also 20,000 that we must have bought by investing 10 lakhs, which means the NAV on that date. Okay, so I can just conclude this now. Can I say therefore NAV on 1/4/15, or basically the issue price, right, on 1/4/15 would be, we invested 10 lakhs. Everyone clear? We invested 10 lakhs and the number of units that we got are 20,000 on that particular date. So of course 10 lakh divided by 20,000, right? The NAV on that date must be rupees 50. Everybody clear? And that's what they are asking you. Calculate the NAV or the issue price on 1/4/15. It is rupees 50 for the bonus plan. Dividend plan we already completed. So with that, students, we complete question number 5 of mutual funds. Let's now move to the next question.
Now question number 6 is a question on derivative analysis and valuation, and it is very similar to the type of question that we have solved in the class. A 2-year tree for a share of stock in ABC Limited is as follows. So they have given the potential moves that a stock could make over a 2-year period. So from 100, in the first year it could go up to 108 or it could go down to 95, and in the second year, if it goes to 108 in the first year, in the second year it could go up to 116.64 or 102.6, or alternatively, if in the first year it goes down to 95, it could go to 102.6 or 90.25. So these are the potential moves that the stock could make over a 2-year period. Okay. Now, consider a 2-year American call option on the stock of ABC with a strike price of 98. So the strike price is 98. The current price of the stock is 100. Risk-free return is 5% per annum. So R is 5% per annum with a continuous compounding. So that means this 5% is a continuously compounded rate of interest, CCRI. And they have obviously given the value of e raised to 0.05 as 1.05127. Assume 2 time periods of 1 year each. Using the binomial model, calculate the probability of the price moving up and down and expected payoff at each of the nodes, that is N1, N2, N3, round off up to 2 decimal points. So we are required to calculate the probability of the price moving up and down, and we are also required to calculate the expected payoff at each nodes, right. So now let's just construct the multi-period payoff. The current market price is 100, right. It can move up to 108 or it can move down to 95, and from 108 it can move up to 116.64 or it can move down to 102.60, and from 95 it can move to 102.60 or it can move to 90.25, right. And the nodes specified are N1, N2, N3, okay. Now, the first thing we are required to do is find the probability. Now, as we have learnt in the binomial risk neutral model, we say let Pu be the probability of the stock price going up and PD be the probability of the stock price going down, right. Okay. Now, therefore, since Pu and PD are the probabilities, we can say that Pu plus PD is equals to 1 or PD is equals to 1 minus Pu, right. Okay. Now, this call has got a strike price of call has got a strike price of 98. Now, if the call has got a strike price of 98, then what will be the value of the call on expiry if the market price of the stock is 116.64? See, if the market price of the stock on the date of expiry is 116.64, then the right to buy at 98 will obviously be in the money. And if this option is in the money, then on the last day, its value will be equal to the intrinsic value, which will be 116.64 minus 98, which is 18.64. Similarly, if the price of the stock on expiry is 102.60, again, it will be in the money, right? So, that means the value of the call with a strike price of 98 will be 4.6, and if the market price is 90.25, then the right to buy at 98 will be out of the money and it will have a value of 0. Now, please remember that these are the values of call, the potential values of call on expiry. Okay. Now, as per binomial risk neutral, we know that the current market price of a stock is nothing but the present value of future probable values. Right? Which means current market price 100 is nothing but the present value. Now, what is the present value? 1 upon e raised to 0.05, because this is a continuously compounded rate of interest. So, the discounting also has to be on a continuously compounded basis. So, 1 upon e raised to 0.05 into, now the future probable values from this point is 108 and 95. So, 108 upward move with a probability of PU plus 95 downward move with a probability of PD. Right. Now, we can write this as 100 equals to 1 upon e raised to 0.05 into 108 PU plus 95, and we know that PD is nothing but 1 minus PU. So, we substitute the value of PD as 1 minus PU. Okay. Now, simplifying this, 100 equals to 1 upon e raised to 0.05, 108 PU plus 95 minus 95 PU. Now, we know the value of e raised to 0.05, they have already given it in the question, right, which is 1.05127. 1.05127 100 into 13 PU plus 95. Now, if you solve this, you are going to get 10.127 equals to 13 PU, or PU equals to 0.78. Now, if PU is 0.78, therefore, PD will be 1 minus 0.78, that is 0.22. So, these are the probabilities of the stock price going up and going down. So, this answers the first part of the question's requirement. Now, they want us to calculate the value of payoff at each node. Now, understand, the payoff at each node is nothing but the value of the call at each node. So, what we are going to do is, we are going to find the value of the call or the payoff at N2 and N3, and then Using the value of the call at N2 and N3, we will find the value of the call at N1. Now, if you recollect binomial risk neutral model, how is it that we find the value of the call today? Now, the value of the call today is nothing but the present value of the value of the call on expiry, of course with the probability factored in. Now, in this case, we already know the value of the call on expiry, which is it could be 18.64, 4.6 and 0. So, now what we are going to do is, using this two values with the probabilities and the discounting factor, we are going to find the value using these two and the probability and discounting. We are going to find the value of call at this point in time, that is N2. Similarly, using this value and this value with the probability and the discounting, we are going to find the value of the call at N3, and then again using N2 and N3, using probability and discounting, we are going to find the value of the call at node N1. Now, first of all, let us find the value of the call at node N2. Value of call at node N2 will be present value of, now 18.64, present value of 18.64 multiplied by the probability of going up plus 4.6 into the probability of its going down, right. So, that would be present value of 18.64 into 0.78, which is the probability of the stock price going up, plus 4.6 into the probability of its going down. Now, present value is nothing but 1 upon e raised to 0.05 into 18.64 into 0.78 plus 4.60 into 0.22. Now, we know e raised to 0.05, the value is already given, 1 upon 1.05127 into 18.64 into 0.78 plus 4.6 into 0.22. This should give a value of 14.79. That means the value of the call at N2 is 14.79. Now, similarly, we find the value of the call at node N3. Value of call at node N3. Now, this will be the present value of 4.6 into the probability plus 0 into its probability, right. So, 4.6 into 0.78 plus 0 into 0.22. Present value is nothing but 1 upon e raised to 0.05 into 4.60 into 0.78. Since 0 into 0.22 would be anyway 0, so I am just not writing this, and we know that this e raised to 0.05 is 1.05127 into 4.60 0.78. You solve this, you are going to get 3.07. 3.41. That means the value of call at node N3 is 3.41. Now we have got to apply the same technique, that is the value of the call N2 into its probability plus the value of the call at N3 into its probability. The present value of that should give us the value of the call at N1. So therefore, value of call at node N1 is nothing but present value of 14.79 into 0.78 plus 3.41 into 0.22. Now present value is 1 upon e raised to 0.05 into 14.79 into 0.78 plus 3.41 into 0.22, and 1 upon e raised to 0.05 is given as 1.05127 into 14.79 into 0.78 plus 3.41 into 0.22. You solve this, you should get the value of the call as 11.69. This is the value of the call today, that is at node N1, or in other words, this is nothing but the payoff at call N1. Now let's move on to question number 7. Question number 7 is identical to a problem which is there in JKSC's class textbook and a sum that we have very well solved in the class. Shyam buys 10,000 shares of X Limited at 25 per share and obtains a complete hedge of shorting 400 nifties at 1100 each. That means this person Shyam is buying 10,000 shares, and in order to protect his position of buying the shares, he sells nifty, and he sells 400 nifty at 1100 each. He closes out his position at the closing price of the next day when the share of X Limited has fallen by 4% and the nifty future has dropped by 2.5%. What is the overall profit or loss from this set of transaction? So now we've got to individually calculate the profit or loss on his share position and the profit or loss on his nifty short position, and then arrive at the overall net profit or loss. So this is say for his shares, and this is, let's say, for his nifty position, right? So on day 1, he is buying 10,000 shares at a price of rupees 25, and simultaneously on day 1 he is selling 400 nifties at rupees 1100. So these are the two trades that he is undertaking on day 1. Now the question states that on day 2 he is closing out all of his position. So that means on day 2, with respect to shares, he will sell 10,000 shares at what price? Now see, the question clearly states that by the next day the share of X Limited has fallen by 4%. That means the price of these shares next day would be 25 minus 4%, that is rupees 24. Now, as far as the shares are concerned, he has purchased the shares at 25 rupees and he is selling the same at 24 rupees, thereby incurring a loss of 1 rupee per share. So, loss per share is equals to rupee 1. But then he has taken a position of 10,000 shares. Therefore, total loss on shares is 10,000 shares into rupee 1, that is rupees 10,000. Now remember, this is a loss. Now let us see what is happening on the Nifty front. Now on day 1 he has sold 400 Nifties at 1100. Now on day 2 he is going to close out this position also. Now how do you close out a sell position? Obviously by entering into a buy transaction. So buy 400 Nifty at what price? Now if you look at the question, it says that by the end of day 2 Nifty future has dropped by 2.5%. So the price of this Nifty will be 1100 minus 2.5%, which is 1072.5. Now you have sold the Nifty at 1100 and now you are buying it back at 1072.5. So this will obviously give rise to a profit per Nifty of 27.5. Therefore, total profits on Nifty will be 400 Nifties into 27.50 is the profit per Nifty. Now this gives us 11,000 rupees profit. Now if you look at this, you've got a profit here of 11,000 rupees and you've got a loss here of 10,000 rupees. So what is this overall net position? So overall net profit, therefore overall net profit will be 11,000 minus 10,000, that's 1,000 rupees will be the overall net profit on both set of the transactions. Now let's move on to the next question, that is question number 8. Question number 8 is a question on foreign exchange exposure and risk management. Again, the question is very similar to the type of question that we have solved in the class with a slight variation. XYZ has taken a 6-month loan from its foreign collaborator for USD 2 million, right? So therefore, there is a borrowing of 6 months for a sum of $2 million. Interest is payable on maturity at LIBOR plus 1. The following information is available. Spot rate rupee dollar is 68.5275 and 6-month forward rupee dollar is 68.4575. They've given the 6-month LIBOR for dollar is 2% and 6-month LIBOR for rupee is 6%. Now understand, since our borrowing is in dollars, we will be required to pay and calculate the interest also in terms of dollars. Now the rate of interest applicable for the dollar loan would obviously be the LIBOR which is applicable for dollars, that is 2%. You are required to calculate the rupee requirement if forward cover is taken and advise the company on the forward cover. What will be your opinion if the spot rate of rupee dollar is 68.4275? Now, amount of loan is $2 million, that is 20 lakh and this borrowing is for 6 months. So you will have to pay interest on this borrowing, add interest at LIBOR plus 1%. Now obviously this LIBOR plus 1% is per annum basis, and they have given that the 6-month LIBOR for dollar is 2%. That means the rate of interest that you will have to pay is 2 plus 1, that is 3% per annum on 20 lakh dollars for 6 months. That is, this will be 3 by 100 of 20 lakhs into 6 by 12. Now this will give us an interest amount of $30,000, which means the total amount that you will have to repay at the end of 6 months, amount to be repaid after 6 months is $20 lakh 30,000. Now what does the question ask you? The question asks you to calculate the rupee requirement if you enter into a forward cover with respect to this obligation. That is, you have to pay $20 lakh 30,000 after 6 months. So what happens if you take a forward cover? What will be the amount of rupee that will be your outflow if you take a forward cover? Now students, at what rate will you take the forward cover? You will obviously take the forward cover at the 6-month forward rate of 68.4575. So therefore, rupee outflow to settle the payable of $20 lakh 30,000 if forward cover is taken at $1 equals to rupees. Now what was the rate? 68.4575. 68.4575. Now this would be ₹13 crores 89 lakh 68,725 rupees. This will be the rupee outflow if you enter into a forward cover. Now that takes care of the first part of the question. What does the second part says? Advise the company on the forward cover. Now if you see the spot rate, it is 68.5275, but the 6-month forward rate is 68.4575. Now this clearly tells us that the dollar is depreciating. If we expect this trend of dollar depreciation to continue in the future, then obviously we will tell the company not to enter into the forward cover right now because you expect the dollar to depreciate further. But if you think that dollar will not depreciate anymore and in fact it might start appreciating, then your advice to the company will be to enter into the forward cover and lock in the payable at 68.4575, right? So the advice to the company will be as follows. From the spot and forward rate, it is apparent that dollar is depreciating. If we expect this trend to continue, that is, dollar will depreciate further, then our advice will be to keep the position open and not enter into a forward cover. Right? However, if we are of the opinion that the dollar has bottomed out, that is, it will not depreciate any further, then our advice will be to enter into a forward contract and lock in the payable at $1 equals to rupees 68.4575. This would be our advice to the company. So that takes care of the second part of the question. Now, the third part. What will be your opinion if the spot rate of rupee dollar is 68.4275? Now, students, if the question is changing the spot rate, then it obviously means that the forward rate will also change, right? So now we have to calculate the rupee outflow based on the revised forward rate. So the question here is, how would you calculate the revised forward rates? Simple. They have given the spot rate, the new spot rate, and they have given the interest rates for both the countries, right? So therefore it is quite easy now to calculate the forward rate. So third part, rupee outflow if spot rate is $1 equals to 68.4275. Okay. Now, spot $1 equals to 68.4275 rupees. Interest rates per annum. Now, as far as dollar is concerned, the interest rate is 2% and for rupee it is 6%. Therefore, 6-month forward rate will be $1.01 because this is 2% per annum. So, for 6 months it will be 1% and this will be 68.4275 plus 3%. 68.4275 plus 3%, that is 70.4803, or $1, 70.4803 divided by 1.01 is 69.7825. Now, since forward rate is quoting at $1 equals to 68.4575, and according to you the rate should be 69.7825, but the banker is actually giving you a quote of 68.4575. Therefore, forward cover should be taken. This will be our opinion. See, if you see this, what will be your opinion if the spot rate is so much? So, this will be our opinion if the spot rate is 68.4275. Moving on to the next question, that is question number 9, which is again a question on foreign exchange exposure and risk management. Again, this sum is a sum which we have solved in the class. It's exactly the same sum with the same figures. Messrs. A Limited is planning to import an equipment from Japan at a cost of 3,400 lakh yen. The company may avail loans at 18% per annum interest with quarterly rests with which it can import the said equipment. The company also has an offer from Osaka branch of an Indian bank extending credit for 180 days at 2% per annum against opening of an irrevocable letter of credit. And additional information which is given is present exchange rate rupees 100 equals to 340 yen and 180 days forward rate is rupees 100 equals to 345 yen. Commission charges for LC is at 2% per 12 months, which is nothing but 2% per annum. Advise whether the company should accept the offer. Now, this sum involves evaluation of two different alternatives available for buying the machine. One is the company can buy the machine by availing a domestic loan which is available at 18% per annum, or alternatively it can obtain the funding from a Osaka based Indian bank which is willing to give this money at 2% per annum. However, it says that if you want to get money from us, you have to open a letter of credit, which is nothing but a bank guarantee. So, our objective in this question is going to be evaluate both the alternatives and decide which one is cheaper. Now, let us evaluate first rupee outflow if domestic funding is availed. That is, you avail the funding from a domestic bank at 18% per annum compounded quarterly. It is given na quarterly rests. So, now if you avail from the funding from a domestic bank, see what is going to happen is you have to pay the supplier today. So, this domestic bank will buy 3,400 lakh yen from the market at spot rate and it will then hand over the yen to the supplier to whom you have to make the payment. So, the supplier is now happy and gone, he has received his payment. Now, the bank, what it will do is, it will debit your account with whatever rupees it has spent to buy the 3,400 lakh yen. Whatever rupee it has spent to obtain the 3,400 lakh yen, that much rupee it will debit to your account, and on that it is going to charge you interest at 18% per annum compounded quarterly. Now, what is the amount of rupees that this bank would have spent to buy 3,400 lakh yen at spot rate? Now, remember they have given the spot rate as rupees 100 equals to 340 yen, which means amount funded at rupees 100 equals to yen 340 with respect to $3,400 lakh yen. So 100 rupees equals to 340 yen. Therefore, 3,400 lakh yen would be rupees 1000 lakhs. So this domestic bank would have spent 1000 lakhs, purchased 3,400 lakh yen and handed over the yen to the supplier, right? And it will debit your account with 1000 lakh rupees, on which it will charge interest at 18% per annum, compounded quarterly. Now, please remember that we are evaluating the funding for a period of 180 days. So in a period of 180 days, there are going to be 2 quarters, that means 2 compounding effects. So add interest at 18% per annum for first quarter on rupees 1000 lakhs, right? So this would be 1000 lakhs into 18 by 100 into 3 by 12, right? So this would be rupees 45 lakhs. Then it will also charge interest for the second quarter. Add interest at 18% per annum for second quarter on, now understand that for the second quarter it will charge interest at 18% on a sum of 1045 lakhs, because the rate of interest of 18% is compounded every quarterly, right? So on rupees 1045 lakhs, this will be 1045 into 18 by 100 into 3 by 12. So that will be 47.03 lakhs, which means the total rupee outflow if we avail the funding from a domestic bank will be 1000 lakhs plus 45 plus 47.03, which is rupees 1092.03 lakh rupees. So this is our rupee outflow under option 1, that is where we avail funding from a domestic bank. Now let us evaluate what will be the rupee outflow if we avail the funding from the Osaka based branch of an Indian bank. So option 2, which is avail funding from Osaka based branch. Now understand what is going to happen. See, this branch which is located in Osaka, it will pay 3,400 lakh yen to the supplier, right? And you will have to pay the Osaka based branch 3,400 lakh yen plus interest on that yen loan at the end of 6 months. So in this case, the rupee outflow which will happen to you will be at the rate which will prevail at the end of 6 months. So now what is going to be that outflow? First of all, amount funded is 3,400 lakh yen, and on this the bank is going to charge you 2% per annum interest rate. So add interest at 2% per annum for 180 days. Now you might wonder why I have taken 180 days, I could have very well taken for 6 months. The reason why we are being so specific is that the Indian bank extending credit of 180 days. Now you can solve the problem using 6 months also, the difference is going to be very minor. But sticking to the solution which has been given by the institute, we take it on the basis of 180 days, that is 3,400 lakh into 2 by 100 into 180 by 365. This is how the institute has solved it. That gives us 33.53 lakh yen, which means at the end of 6 months we will have to pay amount payable at the end of 6 months is yen 3433.53 lakhs. Now what will be the rupee outflow to pay this amount of yen at the end of 6 months? Now that obviously will take place at the 6-month forward rate. So rupee outflow to settle the payable of yen 3433.53 lakhs at rupees 100 equals to, now what is the 6-month forward rate? The 180-day forward rate is given as 100 equals to 345 yen. 100 is equals to yen 345. So this will give us a rupee outflow of 995.23. Now, is this the only rupee outflow which is going to happen in this case? No, because the Osaka branch is willing to fund you provided you open a letter of credit. Now, obviously, you will have to incur some charges for opening the letter of credit, and the question has clearly given that the charges for opening letter of credit is 2% for 12 months, that is 2% per annum. Now, LC opening charges. Is 2% of, now this is obviously 2% per annum of 3,400 lakh yen, right, which will be 34 lakh yen. Now, when do you think you have to pay the LC opening charges? Would you be required to pay the LC opening charges at the end of the 6 months or right on day 1 when you are taking the LC from the bank? Obviously right on day 1, right? So if you have to pay 34 lakh yen right on day 1, then obviously the rupee outflow with respect to this LC opening charges will be calculated at the spot rate. So rupee outflow for LC opening charges at rupees 100 equals to 340 yen will be rupees 10 lakh. Now please understand these figures are in lakhs. Now you have to consider one more thing out here. What is that? This 995.23 lakh outflow is happening at the end of 6 months, but this 10 lakh rupee outflow is happening right on day 1. So obviously you will have to factor in the interest cost on this 10 lakhs, and we know that the domestic rate of funding is 18% per annum. Now here there are two alternative treatments which are possible and which have also been adopted by the institute in the past. Now first of all, I will solve it using the alternative that the institute has used in this RTP. And what is that? They have charged interest on this 10 lakhs, add interest at 18% per annum for 2 quarters, that is 6 months. That is rupees 0.90 lakhs, giving us a total rupee outflow of, the sum total of these three is rupees 1006.13 lakhs. Now, your rupee outflow under the first option is 1092.03 lakhs, whereas under the second option it is 1006.13 lakhs. Therefore, our conclusion, it is cheaper to avail funding from Osaka based branch. This is the solution which the institute has given. Now, I just said that there is an alternative solution also which has been used by the institute in the past. That is this 0.90 lakhs. Now, you notice they have calculated interest on this 10 lakhs at straight 18% per annum. Whereas in the question it is clearly given that whenever you avail domestic funding, the rate of interest that is applicable for you is 18% per annum compounded quarterly, which logically means that even on this 10 lakhs, if you are going to calculate the rate of interest applicable for you, it will be 18% per annum compounded quarterly. Now, in that case, the rate of interest here would be, on this 10 lakh, it would be 0.45 lakhs for the first quarter and 0.4703 lakhs for the second quarter. Now, you will notice that if you add these total up, it is going to be 0.9203, which is going to give you a slightly different answer from this. Right? So, this has been the solution which has been given by the institute earlier. But in this RTP, they have decided not to do the compounding and calculate the interest on this 10 lakhs on a straight basis. So, my suggestion would be that you stick to what the institute has done in this RTP. Now, let us move on to the next question, that is question number 10. Now, this question is a question from the chapter of International Financial Management, something that we teach in our classes as foreign investment appraisal. A US based company is planning to set up a subsidiary company in India, where so far it was exporting. So, there is a US company and till now it was exporting into India, but now it has decided that it will set up a subsidiary in India itself. In view of growing demand for its product and competition from other US based companies, the initial project cost consisting of plant and machinery including installation is estimated to be 490 million US dollars. The net working capital requirement is estimated at 60 million US dollars. The company follows straight line method of depreciation. Currently, the company is exporting 2 million units every year at a unit price of US dollar 90 and its variable cost per unit being US dollar 50. So, right now the company is exporting into India, but since it is deciding to set up a subsidiary in India, we have to realize that one of the impact or one of the fallout of the company setting up its subsidiary in India is that the export sales will no longer happen, right. So, that means it will generate revenue from subsidiary, but it will lose out on the export sales which it was so far making. So, when evaluating this project as to whether the subsidiary should be set up or not, we will consider the revenues from subsidiary, but at the same time we will also consider the loss of revenue which the US company was earning so far from its export. The CFO of the company has estimated the following operating cost and other data in respect of the proposed project, that is for the subsidiary. Variable operating cost will be $30 per unit of production. Additional cash fixed cost will be $30 million per annum, and the project share of allocated fixed cost will be $3 million per annum based on the principle of ability to share. Expected useful life of the proposed plant is 5 years with no salvage value. Production capacity of the proposed project in India will be 5 million units. Existing working capital investment for production and sale of 2 million units through exports was $25 million US. Now you have to be careful here. This $25 million working capital was the working capital requirement when the company was exporting. Right? Now, once the company sets up a subsidiary in India, it will no longer have its export, which means this $25 million which was the working capital requirement for the export will now be released. Okay. Export of the product in the coming year will decrease to 1.5 million units provided the company does not set up subsidiary in India in view of the presence of competing other US based companies that are in the process of setting up their subsidiaries in India. Okay. Applicable corporate income tax rate is 35% and the required rate of return for such project is 12%. Assuming that there will be no variation in the exchange rate of two currencies and all the profits will be repatriated as there will be no withholding tax, estimate the net present value of the proposed project in India and give your advice. Present value interest factor PVIF at 12% for 5 years is given below. Now, what is going to be our overall approach for this problem? It's simple. It's a 5-year project. Therefore, there is going to be certain cash flows that we are going to earn on account of this subsidiary. So, we will calculate the present value of all those cash inflows. Against that, we will also factor in the fact that on account of setting up this subsidiary, there is going to be a loss of the export business, right? And of course, we will calculate the present value of the cash inflows. From that, we will reduce the initial cash outlay which is going to be required for setting up the subsidiary, and we calculate the net present value of the cash flows. If the net present value is positive, then we say that we go ahead and set up the subsidiary, and if it is negative, we say that we will not set up the subsidiary. So, that is going to be the overall approach. Now, first of all, let us calculate the initial cash outlay which is required. Initial cash outlay now, the question very clearly says that the initial project cost is going to be $490 million. So, plant and machinery or the project cost, whatever, plant and machinery is $490 million. Now, in addition to this, there is going to be a working capital requirement of, now what is the working capital requirement for the new project? $60 million. But at the same time, when you are setting up this subsidiary, the working capital of the erstwhile export business will be released, right? So, release of existing working capital. Now, what is the existing working capital? It is existing working capital is $25 million. So, this will be reduced, which means the net initial outlay is 525 million. This is going to be the initial outlay. Now, we calculate the cash inflows which are expected to take place from the subsidiary which the company is planning to set up. Okay. So, cash inflow through subsidiary in India. Now, how do we calculate the cash inflows? Simple. They have given the sales figure, sales. Now, what is the sales? Sales is production capacity of the proposed project in India will be 5 million units. So, we will presume that whatever is being produced will be sold. So, sales 5 million units into the selling price. Now, what is the price at which these units are expected to be sold? Currently, the company is exporting 2 million at $90, and we presume that the same selling price is maintained. So, into $90, that is $450 million, then less variable cost 5 million into, now what is the variable cost? Variable cost will be 30 per unit of production into 30, that is $150 million. Then there is fixed cost. Now, you notice something about the fixed cost. See, they are saying additional cash fixed cost will be $30 million and the project share of allocated fixed cost will be 3 million. Now, see, this project's allocated fixed cost is not really relevant for us. What is relevant for us is how much hard cash is actually going out for setting up this project, and that is 30 million. Now, you might decide to allocate it on whatever basis, that does not matter. What matters is the actual cash outflow, which is 30 million per annum. So, the fixed cost is $30 million, and then depreciation. Now, depreciation would be 490 million is your plant and machinery project cost, and they say that it has got a life of 5 years and the company is following a straight line method. That is 490 divided by 5, which is $98 million. Now, this gives us earnings before interest and tax EBIT of, if you calculate this, you will come at $172 million. Now, obviously, there is nothing mentioned about interest, so we need not worry about the interest. On this, we will pay taxes at, now what is the tax rate they have mentioned? They have said that the tax rate is 35%. So, taxes at 35%. So, this will be $60.2 million. Which gives us earnings after tax of $111.80 million. Now, since we are going to evaluate the cash flows, we need to add back the depreciation. Add depreciation, which is $98 million, which means cash flows after tax is $209.80 million. Now, this is going to be the cash inflow through the subsidiaries operation. But please remember that by virtue of setting up this subsidiary, you are losing out on the revenue that you were generating through exports. So, what was the revenue that you have lost on account of stopping this exports? See, however, due to setting up a subsidiary in India, the company is losing out on exports business, right. Therefore, the export profits which are now lost is as under. So, what was the amount that we were earning through exports? See this, sales. Now, you notice something which they have mentioned here, export of the product in the coming year will decrease to 1.5 million units. So, had you been carrying on the export business in the future years, your sales would have been 1.5 million units. So, now when you are calculating the business that you will lose, you will have to take the sales as 1.5 million units. So, sales is 1.5 million into $90, which is $135 million, okay, less variable cost, which is 1.5 million into dollar. Now, what was the variable cost? See this. Currently, the company is exporting 2 million units at a price of 90, its variable cost being 50. So, that means the variable cost with respect to the export business is 1.5 million into 50, that is 75 million, right. Now, that is all. You are not going to consider fixed cost, because anyways remember the fixed cost with respect to the export business has already been incurred, and that is a sunk cost, right. So, that means the profit before tax is 60 million less tax at 35% is $21 million. Therefore, cash flows after tax, since there is no depreciation also, cash flow after tax is $39. This is the cash flow that you will lose every year, which means net cash flow after tax, every year will be whatever the cash flow after tax you are going to earn from the subsidiary minus whatever revenue or cash flow after tax you will lose out on account of stopping of the export business, that is 209.80 million minus $39 million, which is $170.80 million. This is the net cash inflow that you are going to earn from the subsidiary which you are going to set up. Now, we have to calculate the present value of these cash flows, that is NPV calculation. Right? Year 1 to 5. Now, why we are taking year 1 to 5? Because every year you are going to earn a net cash flow of 170.80, right. So, that means cash flow is 170.80 million, and since this is year 1 to 5, what you need is the PVAF factor for this to find the discounted cash flow. So, the PVAF factor, have they given it in the question? No, they have given the PVIF. So, we can very well add all this up. So, that will be 0.8929 plus 0.7972 plus 0.7118 plus 0.6355 plus 0.5674. So that's 3.6048. So we can say 3.6048, this is your discounting factor, right. So your discounted cash flows will be 170.8 into 3.6048. This is 615.6998. If you want, you can round it off to 615.700. And then in year 5, there is going to be another cash flow. Now, what is this cash flow going to be? See, for setting up this new subsidiary, you put in 60 million as working capital, but then at the same time, 25 million of your existing working capital got released. That means the net amount of investment for working capital is 60 minus 25. I mean, think of this. You put in 60, but you withdrew 25. That means your net investment in working capital is only 35, which will get released at the end of 5th year, right? So that will be 35 million, which you will discount using the present value interest factor for the 5th year, which they have given in the question as 0.5674. 0.5674. So the discounted cash flow for this would be 35 into 0.5674, which is 19.859. Now the sum total of this will be the present value of cash flows, 19.859 plus 615.6998, that is 635.5588. Now from this we reduce less initial cash outflow, which we had calculated here as 525 million. Therefore, NPV of the project will be 110.5588, and since this NPV is positive, therefore it makes sense for the company to go ahead with the plan of setting up the subsidiary. Therefore, advisable for the company to set up the subsidiary. Now moving on to question 11, which is a question on interest rate risk management. P Limited, a dealer, quotes a all-in cost for a generic swap at 6% against 6-month LIBOR flat. Now what does this sentence mean? See, this means that the company will pay a flat rate of 6% and it will receive the 6-month floating rate. Now you know, under interest rate swap, whenever you undertake an interest rate swap, you are going to pay something and in return you are going to receive something. So in this case, it is said that you are going to pay 6% against 6-month LIBOR flat, and the notional principal amount of the swap is 8 lakh. So this 8 lakh rupees is going to be the notional amount on which all the calculation of interest is going to be based. 1. Calculate the semi-annual fixed payment. That is, what is the amount that you would have to pay on the fixed leg of the transaction, the fixed rate of interest. What is it that you have to pay? So obviously the fixed rate of interest is 6%. So the semi-annual fixed payment fixed payment will be 6% of rupees 8 lakhs into. Now, if you look at the question, they have asked us to calculate the semi-annual fixed payment. Find the first floating rate payment for the above if the 6-month period from the effective date of the swap to the settlement date comprises 181 days and that the corresponding LIBOR was 5% on the effective date of the swap. Now, in question number 2 above, if the settlement is on a net basis, how much the fixed rate payer would pay to the floating rate payer, and generic swap is based on 30 by 360 day basis. That means every month is to be considered for 30 days and the year will be considered for 360 days. Now, since they have asked us to calculate the semi-annual fixed payment, that means the 6-month period would comprise of 180 days and the year anyway we have to take it as 360 days. So, this will be 180 upon 360. So, that would be rupees 24,000. This would be the semi-annual fixed payment. So, that takes care of the first part of the question. Now, second part, find the first floating rate payment for one above. So, we have to now calculate what is the floating rate amount that is going to be received. Now, for that obviously we need to know what is the floating rate. Now, that has been given. If the 6-month period from the effective date of the swap to the settlement date comprises of 181 days, so that is the period for which you will calculate it, and that the corresponding LIBOR was 5% on the effective date of the swap. So, this is your floating rate payment. Therefore, floating rate payment is 5 by 100 of rupees 8 lakhs into 181 by 360. Now, if you solve this, you will get rupees 20,111 or say rupees 20,120, right? Okay. That takes care of the second part of the question. Now, third part, in question number 2, that is here, if the settlement is on the net basis, then how much the fixed rate payer would pay to the floating rate payer? The person who will make the fixed rate payment will obviously receive the floating rate. Now, just imagine this. If you were the person who are paying the fixed rate, that means you will pay 24,000, but in return you will have to receive 20,120. Now, if the settlement is going to be on a net basis, that means the amount that you will pay will be the net amount. So, net amount to be paid by the fixed rate payer will be 24,000 minus 20,111. Sorry, we are taking this as 2120. So, let us stick to that 2120, that is 3880. This is the amount which the fixed rate payer would pay on a net basis to the floating rate payer. And this also makes sense, no? I mean, just think of this. If I have to pay you 24,000 and I have to receive 20,120 from you, then I would rather say that instead of me giving you 24, you paying me 20,120, I will give you a net amount of 3880, right? So, that is how the net settlement is done. So, that, students, brings to end my side of the discussion on the RTP for May 23. Wish you all the very best for the exam. Take care.
Okay friends, so now that you are done with question 11, let us go to question number 12 from the chapter of corporate valuation. Now students, this question that you see, question number 12, this question is an old ICAI question asked many times. They used to ask it as Eagle Limited, now they have done it as Excellent Limited, right? And numbers slightly they have changed, right? Otherwise everything is same ditto as it is, right? Only the numbers have changed. Otherwise the framing of the entire question, the data given, everything is of similar, or I might say same nature, only the numbers have changed. So what I will do is I will pull out my video of Eagle Limited question, which is an old ICAI question, and I will show it to you from my online course of SFM. Please watch it. You will be very easily able to understand question number 12. Here is the video. Hello friends, so welcome to one more question, that is question number 4. I request everyone to please pause the video and read the question carefully. Okay friends, I hope you all read the question. Let us now try to understand it, okay? Eagle Limited reported a profit of 77 lakhs after a 30% tax for the financial year 11-12. So what is Eagle Limited? It's a company. They are saying that our just concluded profit is rupees 77 lakh after tax. So this I'm very sure you understand is NPAT, net profits after tax. An analysis of the accounts revealed that the income included extraordinary items of 8 lakhs and an extraordinary loss of 10 lakhs. The existing operations, except for the extraordinary items, are expected to continue in future. So what they are saying, I'll explain to you from year to year only. Please pay attention. They are saying there is this company called Eagle Limited, okay? Eagle Limited has just reported a profit of 77 lakhs, which is after tax. But then when we analyzed these accounts, we understood that this profit has been calculated after tax, no doubt about it. But there have been some extraordinary incomes of 8 lakhs and extraordinary losses of 10 lakhs which have been included in the calculations when this 77 lakhs was calculated. Everybody following? Now children, do you realize that as far as past profit is concerned or just concluded, just reported profit is concerned, it is of absolutely no use for me as far as valuation of a business using DCF technique is concerned, because valuation of a business using DCF technique is dependent not on the already reported profits but on the expected upcoming future profits. Everybody following? So for that they are saying that the existing operations except the extraordinary items. So they are saying that in this income statement that must have been made and it ended at 77 lakhs, everything is expected to continue as it is in future, which means the profit will be same in the coming years also, except that the extraordinary items won't be there, which means 77 lakh won't be the profit, correct? Why 77 lakh won't be the profit in the coming years? Because in these 77 lakhs, these extraordinary items are there which need to be flushed out. Once you flush them out, you will find out what is the profit of this company without the extraordinary items, and that, students, we will assume is going to continue in the future also. That is what they are saying in the question. The existing operations except for the extraordinary items are expected to continue in future. In addition, the results of the launch of a new product are expected to be as follows. So they are saying apart from my existing operations, a new product launch is also there which will add on to the cash flows. Sales are there, material costs are there, labor costs and fixed costs are there. These are additional new launch, new product cash flows are there which obviously are not included in the existing operations which reported a profit of 77 lakhs. Everybody following? Let us read ahead. You are required to, point number 1, calculate the value of the business given that the capitalization rate is 14%. Now let me explain this to you. Very simple. First of all, do you realize that capitalization rate is nothing but the discounting rate, correct? For the purpose of DCF technique, to find the PV of CI, the discounting rate to be used is 14%. But the question that will arise is which cash flows to discount and for how many years to discount? Do you realize that as far as the cash flows are concerned, we will have to use this entire data to find out the total expected post-tax profit every year that this particular Eagle Limited is expected to give in the coming years, correct? 77 lakhs will be an irrelevant item, students, because obviously you also understand that 77 lakhs is a profit of the last year, and that too it has extraordinary items. We, for the purpose of valuations, are only interested in the expected post-tax profits. For that, we'll have to do some calculations. Once we do the calculation, we will be able to find out the expected post-tax profit of Eagle Limited in the coming years, but on an per annum basis. Now, if I get the post-tax expected profit of Eagle Limited, that is the upcoming future profits of Eagle Limited in the coming years, that is in the future years, then very good. For the purpose of valuations, anyways we need the future profits, but then to discount them, the rate also is available, no problem with that. What is not available is the number of years for which these cash flows, these profits are expected to happen. Everybody following? So in this situation, what we will do, we will assume that these profits are expected to continue for eternity, for perpetuity, for an indefinite period. Everybody following? And as far as perpetual cash flows are concerned, we know what to do. We have seen bond valuation, we have seen equity valuation. We very well know that value of any investment where the cash flows are perpetual annuity, okay? Annuity. Why am I using the word annuity? Because they have not given to you the growth rate, which means if the growth rate is not there, I'll assume the growth rate to be 0, and therefore do you realize the present value of all future cash flows starting from end of year 1 to end of year eternity, where all future cash flows are of same value, the present value will simply be cash inflows divided by the capitalization rate, correct? If you remember, in an irredeemable bond, if you remember the irredeemable bond, there was only interest for eternity. The present value of all these future interest payments was nothing but interest upon KD. You remember that? Even as far as equity valuation is concerned, you saw that value of equity was nothing but D1 upon KE minus G. Here it is assuming growth, but if the growth rate is not there, I am very sure what is left is D1 upon KE, that is cash inflow upon the R, and that is exactly what I am telling you. If there is no growth rate, present value of perpetual annuity, annuity means same cash flows for perpetuity, the present value is just take any cash inflow per annum obviously and then divide by R. Everybody following? So our goal now is to find out this cash inflow. Basically, you have to find out the net profits after tax expected of Eagle Limited in the upcoming year. Can we start? So see students, what I am doing, please pay attention. Question number 4, I'll write down here point number 1, calculation of value of business. That is what they're asking, right? Calculation of value of business. Students, as far as this is concerned, the first thing we have to find out is the net profits after tax expected in the coming years per annum. So see what I'm doing. Calculation of expected NPAT. Everybody following? Now see how I'm doing it. Please pay attention. I'll write down here particulars. Okay. Then I will write down income statement, okay, of previous year. Everybody following? Income statement of previous year, and I'll write down here income statement, okay, of coming years. Are you listening? Income statement of previous year, income statement of coming years. And students, this entire income statement I am doing for the existing business. New business we will check out later, correct? Now students, I am very sure you understand. Now as far as the income statement of the previous year is concerned, they have given to you that 77 lakh is the NPAT. Now see how I am building up. Please pay attention. NPAT means net profit after tax, correct? I am writing here normal profit before tax. Okay, there must have been some normal profit before tax. In that we would have added the extraordinary incomes. From that we would have subtracted the extraordinary losses. We would have got the net profit before tax, on which we must have subtracted the tax at the rate 30%, and then we must have got NPAT, which is given to us as 77 lakh. Is the story clear? So now let us try to go upstairs, students. As we go upstairs here, we will find the normal profit before tax. Children, do you realize that this normal profit before tax will continue as normal profit before tax in the coming years only, because the question says that the existing operations are expected to continue except the extraordinary items. So to flush out the extraordinary items, what I will do, I will go to that profit which was calculated before these extraordinary items were taken into picture, and that profit, students, I am very sure will remain as it is in the coming years also. So can we start? So how do I go upstairs now? Very simple. Do you realize if NPBT is 100, tax is 30, NPAT is 70. So if I do the cross multiplication, 77 lakh divided by 70 into 100 will give you 110 lakhs, which means this tax must be 33 lakhs. Everybody following? So I'll write down here this line, and now let's go upstairs more. They are telling you in the question extraordinary incomes are 8 lakhs, extraordinary losses are 10 lakhs. I'll write down here 10 lakh losses, 8 lakhs income. Everybody following? Let us now find the normal profit. The normal profit is nothing but, students, 110 lakh plus 10 lakh minus 8 lakh. As we go upstairs, we get 112 lakh as the normal profit before tax in the previous year. Everybody following? You can check 112 lakhs plus 8 lakh is 120, 120 minus 10 lakh is 110 lakhs, minus tax at 30%, 33 lakhs, NPAT comes to 77 lakhs. Everybody following? And this 112 lakhs, do you realize, is expected to continue in the coming years also, but now there won't be any extraordinary items, and therefore the taxable profit NPBT will be 112 lakhs. 112 lakhs into 30%, if I do, 33.6 lakhs is the tax that we pay, and the expected profit therefore, students, comes to 78.4 lakh from the existing business of Eagle Limited, which means Eagle Limited's existing business is expected to give us a post-tax profit of 78.4 lakhs per annum in the coming years, in the future, for eternity. Everybody following? But this is not it. There is also going to be an additional cash flow happening due to the new launch of a new product, correct? From that also we'll be getting the cash flows. So I'll write down here calculation of expected NPAT per annum due to launch of new product. Okay, due to launch of new product. Can we start? So due to launch of new product, what extra cash flows will get? Let us calculate. I'll write down here particulars and I'll write down here per annum. These are expected values, okay? These are not actual past values. These are estimated to happen in the future. So they are saying that due to the launch of the new product, the following cash flows are expected to happen. Sales expected are 70 lakhs. I'll write down here sales 70 lakhs minus material costs 20 lakhs. I'll write down here less material costs 20 lakhs. I will subtract next labor cost 12 lakhs. I'll write down here less labor cost. Okay, labor cost is how much? 12 lakhs. And from that I will subtract last cost, that is fixed cost, 10 lakhs. I'll write down here less fixed costs 10 lakhs. Students, do you realize if I take the final total here, we will get nothing but the NPBT. Everybody following? So 70 lakhs minus 20 minus 12 minus 10 will give us 28 lakhs expected NPBT per annum in future, minus tax at the rate 30% if I do, into 0.3, that is 8.4 lakhs is the tax. So therefore my expected NPAT per annum in the coming years will be 19.6 lakhs. Everybody following? Can I say therefore total expected NPAT per annum in coming years, okay, that is in future, will be nothing but 19.6 lakh from the new product and 78.4 lakh from the existing product. I'll write down here 78.4 lakh plus 19.6 lakhs. If I take my calci, 78.4 plus 19.6, it comes to 98 lakhs rupees per annum expected in the coming years for eternity. And therefore, now that you have received what this business future cash inflows are per annum for eternity, do you realize the value of this business is nothing but cash inflow per annum divided by the capitalization rate. 98 lakhs, we have got the cash inflow per annum expected in the coming years, and the capitalization rate given to you in the question, students, is 14%. I divide this by 14%. If I take my calci, okay, 98 lakh divided by 14%, if I do, I get the value of this Eagle Limited business as rupees 700 lakh. Everybody following? We have just found out the present value of all future 98 lakhs starting from end of year 1, end of year 2, end of year 3 till end of your eternity. All those cash inflows of 98 lakhs, expected cash flows of 98 lakhs, discounted at the rate 14%, the present value is 700 lakhs. Everyone understands the derivation of this formula I have given to you in the valuation of bonds chapter, bond valuation chapter. In that particular segment or module where I have taught you the valuation of an irredeemable bond. Okay, you can check that video for the derivation, but I'm very sure you're done with those chapters and therefore you trust this formula, and this is the valuation, therefore that is rupees 700 lakh. Students, with that we complete point number 1, the value of the business. Then they say in point number 2, determine the market price per equity share, MPS, with Eagle Limited's share capital being comprised of 1 lakh preference shares of 100 each and 50 lakh equity shares of 10 each, and the P ratio being 10 times. Students, P ratio is given, which means they're asking you to find out the MPS as follows: EPS into P ratio. I hope you remember. Students, what is the formula of P ratio? P ratio formula we know is MPS upon EPS, price upon earnings, P ratio. So therefore EPS into P will of course give us the MPS. Students, they have given to you the P ratio in the question. With the help of the P ratio, they are asking you to find out MPS. That means your goal now is to find out what? Your goal is to find out EPS, nothing else. For EPS, we already have the expected NPAT, correct? Students, what is the NPAT that we calculated earlier? 98 lakhs is the NPAT that we are expecting to have in this Eagle Limited, as we saw here, right? 98 lakhs. Students, let's proceed down from here only. Do you realize if I subtract preference dividend from this 98 lakhs, I will get net profit available for equity shareholders, and if I divide the net profit available for equity shareholders by number of equity shares, I will get the earnings per share, and if I multiply the earnings per share by P ratio, I will get the market price per share. Students, as far as PD is concerned, they are saying 1 lakh shares of 100 each, which means 1 crore face value. 13% is the preference dividend rate. 1 crore face value PSC into 13% means 13 lakhs is the preference dividend. I subtract 13 lakhs preference dividend from here. So 98 minus 13 if I do, I'll get 85 lakhs, correct? 85 lakhs is now the net profit available for equity shareholders. This if I divide by the number of equity shares, that is 50 lakhs, I'll get the EPS. 85 lakh divided by 50 lakhs, I get the earnings per share as rupees 1.7, and considering the fact that the P ratio, students, is 10 times, I multiply 1.7 by 10 times, I get the market price per share as rupees 17. Everybody followed this question. With that we complete point number 2. They asked us to determine MPS. We found it to be 17, and with that we complete this question number 4 of Eagle Limited. I hope you understood this question, students. I will now flash the solution of this question on your screens. You can pause the video and copy down the notes. Thank you very much. See you in the next video with another question. Okay friends, so now that you are done with question number 12, I hope you found the similarity very similar. I might say same question, only numbers had changed. Now we'll go to question number 13. Students, question 13 again, now from mergers and acquisitions. This question is also an old ICAI question. Yes, the names also are same, efficient and healthy. Only numbers have changed, otherwise they have kept the question as it is. Nature is exactly same. I'll pull out my video from my SFM online course. On this particular question, only the numbers are slightly different, otherwise everything else is same. Once you watch that video, you will very easily understand this. Okay, so here is the video. Hi friends, so welcome to one more question, question number 8. I request everyone to please pause the video and read the question carefully. Okay, students, I hope you all read the question. Let us try to understand it. See, question number 8. The following information is provided relating to the acquiring company Efficient Limited and the target company Healthy Limited. So can I say Efficient is the acquiring and target is Healthy, correct? Now students, data about Efficient, that is acquiring, and target, that is Healthy, is given. Students, number of shares are given. Market capitalization. Market capitalization means what? Total market value of all shares is given. P ratio is given, reserves and surplus are given, and promoters holding is given. Students, what is the meaning of promoters? I'm very sure you all understand. The ones who had conceptualized the company, the initial investors, the initial people, right? The promoters, their holding is given, which means they say that total shares of the acquiring company are 10 lakh and then promoters holding is given. I'm very sure you know what is a promoter, correct? So for a company, let's say for Efficient Limited, 10 lakh is the total number of equity shares outstanding. Of that, 4.75 lakhs are held by their promoters. Similarly, 7.5 lakhs are the total number of equity shares outstanding in the target company. In that, 5 lakhs are held by their promoters. Board of directors of both companies have decided to give a fair deal to the shareholders, and accordingly for a swap ratio, the weights are decided as 40%, 20%, 35% for earnings, book value and market price of share of each company. I'll explain this to you in a bit. Please pay attention. Now, point number 1. Now, let us do only point number 1. Please pay attention. 2, 3 and 4 will do afterwards. Calculate the swap ratio. Swap ratio means share exchange ratio, and also calculate promoters holding percentage after acquisition. In that also, let us only focus first on the swap ratio, which means they're asking us to calculate SCR. Now, SCR, children, is to be based on what? They are saying that for the purpose of the SCR, that is a swap ratio, you can use earnings per share, book value per share, market value per share. But which one to go for? Because if I do SCR based on earnings per share, there will be one SCR. If I do SCR based on book value per share, there will be another SCR. If I do SCR based on market price per share, another SCR. Which SCR to go for? Children, they are saying that you calculate the 3 SCRs and then these weights you apply, okay? 40%, 25% and 35%. These weights you apply and calculate one weighted average SCR. Everybody following? Yes. So instead of doing a simple average of the 3, we'll do a weighted average. Can we start? So students, I'm writing down now here question number 8, point number 1, calculation of SER. For that, children, we'll first do the SER based on earnings per share, that is EPS. I'll write down SER based on EPS. Tell me the formula. SCR based on EPS is nothing but EPS of target upon EPS of acquiring. Everybody following? EPS of target upon EPS of acquiring. Now, first of all, students, we'll have to focus on calculating the EPS of target and acquiring, correct? How do I find it? This data is available to you. Tell me, how do you find it? Very simple, students. Do you realize that market capitalization value is given, number of shares is given? Can I say market cap, total market cap of Efficient Limited, that is A Limited, acquiring company, divided by their number of equity shares will give you market price per share. Everybody following? So if by using this we can get MPS, P ratio is given to us. I'm very sure you understood. MPS and P ratio can be used to find EPS. Everybody following? And once we have the EPS of both target as well as acquiring, then we can find out the SCR based on EPS, correct? So students, I'm writing down here now EPS for the acquiring company. Okay, for that what I have to do? Students, do you realize for the acquiring company, market price per share will be total market cap divided by number of equity shares, correct? Now, market cap of acquiring company given to you is 500 lakhs and number of shares given to you is 10 lakhs. So, I'll do it here. 500 lakh upon 10 lakh, that will give me rupees 50, correct? Rupees 50, therefore, is the MPS of the acquiring company. As far as P ratio is given, the P ratio, children, is given to you in the question as 10 times. So, I'll write down here 10 times, okay? Now, tell me what to do. Students, do you realize that P ratio is equal to MPS upon EPS? Yes, 10. P ratio is 10 is equal to MPS of 50 upon EPS. Can I say EPS is equal to 50 by 10? That is rupees 5. Everybody following? We got the EPS of which company? Of the acquiring company. Can we similarly do for the target company? So for the EPS of target company, first of all, students, let's find out the MPS of the target company. I am very sure you understand it is 750 lakhs upon 7.5 lakhs. I'll do it here. 750 lakhs upon 7.5 lakhs. That gives you MPS of rupees 100, correct? So the market price per share of the target limited is 100. As far as the PE ratio is concerned, students, their PE ratio is 5 times given in the question. So I'll write down here PE ratio 5 times. Do you realize that the EPS is nothing but MPS upon PE? I hope you understood. That is nothing but 100 divided by 5, that is 20. Rupees 20 is the EPS of the target company. Yes, so now that we have the EPS of the target company, we have the EPS of the acquiring company, can we find the share exchange ratio based on EPS? That is nothing but EPS of target upon EPS of acquiring. EPS of target we have is 20, EPS of acquiring we have is 5. So I'll do here 20 divided by 5, that comes to 4:1. So if the SCR was to be based on EPS, then for one share of target limited, acquiring company would give 4 shares of its own. Everybody following? So we have now got the SCR based on EPS. Next, students, will have to calculate SER based on, what are they saying? Based on, after EPS, book value per share. Okay, book value per share. So I'll write down here based on book value per share. Can we start? What is the formula? It will be book value per share of target upon book value per share of acquiring. Now as far as book value per share of target is concerned, focus hard. For target limited, they are saying in the question, can you focus here, that the number of shares of 10 each are 7.5 lakhs, correct? So can I say equity share capital will be 7.5 lakhs into 10, that is 75 lakhs. I'll write down here 7.5 lakhs into 10. This gives me my equity share capital. Apart from this, children, I'm very sure you understand reserves and surplus are 165 lakhs. So I'll straight away add 165 lakhs. Do you realize this gives me my total equity shareholders funds, correct? Equity share capital plus reserves will give me total equity shareholders funds. This if I divide by number of equity shares given in the question for the target limited is 7.5 lakhs. So I'll straight away write down here 7.5 lakhs. I will get the book value per share. Everybody following? So on the calci now, 7.5 into 10 m plus 165 m plus MRC divided by 7.5, I will get rupees 32. So the book value of target limited, students, is rupees 32. Let us find the book value of acquiring. Book value per share of acquiring company, similarly we will find it is nothing but 10 lakh shares into 10, that is the equity share capital. I'll write down here 10 lakh into 10 plus the reserves of the acquiring company are 300 lakhs. I'll add 300 lakhs to it, the whole divided by obviously 10 lakh shares, that is the number of equity shares of the acquiring company. Can we start? So on the calci now, 10 into 10 m plus 300 m plus MRC divided by 10, I will get the book value per share of acquiring company as rupees 40. Can I say therefore we have the target limited's book value per share, we have the acquiring limited's book value per share. Let us find out the SCR based on book value per share, that is 32. So book value per share of target, students, we know is 32, and book value per share of acquiring we know is 40. So 32 upon 40, if we do 32 divided by 40, we get 0.8:1. So 0.8:1 is the SCR based on book value per share. One more you have to do, I hope you understand. I'll write down here SER based on MPS. Everybody following? SCR based on MPS is obviously MPS of target upon MPS of acquiring. Everybody following? MPS of target, MPS of acquiring we have already found out. MPS of target we found out as 100 and MPS of acquiring we found out as 50. Everybody following? For acquiring company MPS is 50, for target company MPS is 100. Very simple, students. Do you realize 100 upon 50, it will be 2:1. Okay, students, so now we have got the 3 share exchange ratios. First is on the basis of EPS, we got 4:1. Next, on the basis of book value per share, we got 0.8:1. Next, on the basis of MPS, we got 2:1. We have to take a weighted average of these 3, correct? So I'll write down here. Do you realize that weighted average SER is nothing but weight of the share exchange ratio based on EPS into the share exchange ratio based on EPS plus weight of the share exchange ratio based on book value per share into the share exchange ratio based on book value per share plus weight of the share exchange ratio based on market price per share into share exchange ratio based on market price per share. Now the 3 weights given to you in the question are, they are saying 40, 25 and 35, okay, respectively. 40, 25 and 35 for EPS, BVPS and market price. So I'll take 0.4, 0.25 and 0.35. I'll take 0.4, 0.25 and 0.35, correct? Yes, so now I'll multiply these by their share exchange ratios. As far as the EPS share exchange ratio is concerned, they are telling you that the share exchange ratio based on EPS is 4. So I'll multiply 0.4 into 4. Everybody following? As far as the book value per share SCR is concerned, we had got 0.8:1. So students, I will multiply that by the weight of 0.25. So 0.25 into 0.8, and as far as MPS is concerned, we had got it as 2:1, so 0.35 into 2. Everybody following? So students, now on the calcs, 0.4 into 4 M plus, 0.25 into 0.8 M plus, 0.35 into 2 M plus MRC, we get the share exchange ratio weighted average as 2.5:1. This is your swap ratio. The acquiring company has to issue 2.5 of its own shares for every one share of target company. Everybody clear with this? Yes. So with that, students, we complete one half of point number 1, where they asked us to calculate the swap ratio. Everybody clear with this? Now they are saying also calculate promoters holding percentage. Promoters holding percentage after acquisition. Are you listening? Promoters holding percentage after acquisition means post merger these promoters will be holding how much percentage of the post merged firm. That is what is being asked. Both promoters, okay, both will be there in this post merged firm, because A and T are coming together, efficient and healthy are coming together. So both of these promoters will be there in the post merged firm. What is their proportion of holding? What is the promoters holding percentage in the post merged firm is what they are asking. For that, students, will have to first of all calculate how much is the acquiring company giving to the shareholders of target company, how many shares it is issuing. We already received the exchange ratio is 2.5:1, but we have not yet calculated how many shares are to be issued. Tell me, students, how many shares you will issue? Do you realize that their number of equity shares are 7.5 lakhs? Okay, Healthy Limited, Target Limited's number of equity shares are 7.5 lakhs. The Efficient Limited, the acquiring company, is going to issue 2.5 shares per one share of Healthy. So do you realize the number of equity shares that Efficient will issue to the shareholders of Healthy will be 7.5 lakhs into 2.5, correct? So I'll write down here number of shares to be issued, okay, to be issued by acquiring company to shareholders of target company will be 7.5 lakhs into 2.5, because the ratio is 2.5:1. For every one of their target shareholder shares, I will be issuing 2.5 of acquiring company, correct? So if they are 7.5 lakh shares, I will be issuing 2.5 into 7.5 lakhs. Let's take the calcs. 7.5 into 2.5, if I do, I get 18.75. So 18.75 lakh shares I'll be issuing to the shareholders of target company. As far as the post merged firm is concerned, that is acquiring firm post merger is concerned, can I say post merger number of equity shares of the acquiring company will be already what is outstanding, students? Already the existing number of equity shares are 10 lakh. That will continue post merger, right? So it will be 10 lakh already existing shares plus 18.75 lakh newly issued shares. So plus 18.75 lakhs. Total number of shares post merger will be 28.75 lakh shares. Now the question is, of these total post merge number of equity shares, what is the proportion of the promoters holding? Everybody following? Can I say, students, promoters holding in terms of shares will be, as far as acquiring company is concerned, do you realize this 4.75 lakh shares will continue as it is, correct? Because the promoters which were there in A Limited earlier, acquiring companies pre-merger promoters will continue to remain in the post-merger also, correct? So 4.75 lakhs will remain. So I'll write down here 4.75 lakhs, that is there. Plus, now do you realize that the promoters of Healthy Limited will also now hop in into this new company, right? Now when they hop in, are they going to get 5 lakh shares only? No, because I'm very sure you understand that when they were in Healthy Limited, these promoters of Healthy Limited, the Target Limited's promoters, they were holding 5 lakh shares, correct? But when they are now introduced into the new company, the ratio of share exchange is not 1:1. For 5 lakh shares, they will not be getting 5 lakh shares of the acquiring company. They will be getting 2.5 shares per share share, correct? So do you realize if they were having 5 lakh shares in the Target Limited, when they come to the post-merged firm, the number of shares that these promoters of Target Limited will get is 5 lakhs into 2.5. Everybody following? So students, in the post-merged firm, A Limited's existing promoters will be having 4.75 lakh shares plus T Limited's 5 lakh shares of promoters. They will be now converted to 5 lakhs into 2.5 per share. That is 5 lakhs into 2.5. Do you realize these are the number of equity shares that A Limited will be issuing to the promoters of Target Limited? Everybody following? So students, do you realize the total will be 4.75 M plus 5 into 2.5 M plus MRC. It comes to 17.25 lakh, which means out of 28.75 lakh total shares outstanding of acquiring company post merger, 17.25 lakh belong to promoters. That is nothing but 4.75 lakh existing promoters plus the promoters of Target who now walk in at a ratio of 2.5 shares to 1. Everybody following? So students, do you realize therefore the promoters holding percentage will be 17.25 lakh out of 28.75 lakh into 100. If I do 17.25 divided by 28.75%, it comes to 60%. What is 60%, students? 60% is nothing but the promoters holding percentage in the post-merged firm. Is the story clear? Yes. Let us now go ahead. With that, we finish point number 1. Correct? Let us now go to point number 2. What is the EPS of Efficient Limited, that is the acquiring company, after acquisition of Healthy? Basically, they are asking you what? Post merger EPS. Everybody following? So I'll write down here now point number 2, post merger EPS. Come on students, we have been doing this since long now. Post merger EPS formula is what? Post merger earnings, correct? Post merger earnings divided by post merger number of equity shares. Students, I am very sure you understand post merger number of equity shares we just calculated, right? Post merger number of equity shares are nothing but 28.75 lakhs. So I'll divide this by 28.75 lakhs. Now how do I calculate the post merger earnings? Do you remember post merger earnings, assuming no synergy, will be nothing but the summation of the pre-merger earnings of A and T, correct? Students, as far as the pre-merger earnings are concerned, do you realize we have the EPS of A? We found it, right? 5 rupees is the EPS of A, and as far as Target Limited is concerned, 20 rupees is the EPS of Target. Everybody following? 5 for acquiring and 20 for Target, correct? 5 for acquiring and 20 for Target. Students, do you realize that if this EPS I multiply by the number of equity shares, I'll get the total earnings, pre-merger earnings of A and T separately. We'll add both of them, we'll get the post-merger earnings without the synergy benefits, correct? So students, please pay attention. As far as acquiring company is concerned, the earnings per share is 5 into their number of equity shares will give you the pre-merger earnings of acquiring company, and as far as Target Limited is concerned, their earnings per share is 20. This if I multiply by the number of shares of Target Limited, I'll get the pre-merger earnings of Target Limited. I'll add both of them, I'll get post-merger earnings, correct? Let us now take the number of equity shares of A and T. Number of equity shares of A and T, children, given to you are 10 lakh and 7.5 lakh. So I'll multiply this by 10 lakh, I'll multiply this by 7.5 lakh. Let us take the calcies now. 5 into 10 M plus 20 into 7.5 M plus MRC divided by 28.75. I get the post merger EPS as rupees 6.96. Everybody following? Rupees 6.96 is the post merger EPS, correct? Now students, let's go to point number 3. Students, point number 3, what are they asking? What is the expected MPS and market cap of Efficient Limited after acquisition? Now look at this. Assuming P ratio of acquiring remains same. Students, what is the P ratio of acquiring company before the merger? Do you remember? It was 10 times, correct? 10 times was the PE of the acquiring company. What are they saying? They are saying that if this PE remains same post-merger also, then what will be the post-merger MPS and therefore the post-merger market cap? Students, do you realize that we already have the post-merger EPS? If I just multiply the post-merger EPS by the PE ratio of the acquiring company, I will straight away get the market price per share of the acquiring company post merger, correct? So I'll write down here, see, please pay attention. Post merger PE ratio is equal to 10 times. That is assumed to be same as earlier. Therefore, children, post merger market price per share of acquiring company, obviously this is also of acquiring company, I hope you understand, because post merger there is nothing called as T limited. So post merger market price per share of acquiring limited will be nothing but EPS into PE. Post merger EPS into post merger PE. Post merger EPS is 6.96. Post merger PE is 10 times. We will get rupees 69.6. Everybody following? Post merger MPS of acquiring company we got as 69.6, and now they're also asking us post merger market cap. Can the post merger market cap is nothing but post merger market price per share into the post merger number of equity shares, that is 28.75 lakhs. So I'll write down here, therefore post merger market cap is nothing but 28.75 lakh shares are outstanding post merger in that acquiring company. I'll multiply this by the market price per share, that is 69.6. So students, 28.75 into 69.6, I get the post merger market cap as 2001 lakhs. Okay, 2001 lakh therefore becomes the post merger market cap of this acquiring company. That is nothing but post merger number of equity shares outstanding into the post merger market price per share. Everybody clear? Now let's go to the last point, point number 4. They are saying calculate free float market cap of the merged firm. Students, we just found out the market cap of the merged firm, right? 2001 lakh we got. So what is this free float? Children, free float means that market cap which is not held by promoters. I hope you understand. If there are 100 shares in the company, of that 20 are held by promoters, we say 80 are free float shares because they can be floated freely amongst the various investors in the country. Everybody following? They are not held, they are not sat upon only by promoters, they are freely available, free float. So they are now asking you, out of total market cap of the merged firm, post merger market cap, out of that how much is free float market cap? Everybody following? Students, very simple. Do you remember that when we calculated the promoters holding post acquisition, we had got that the promoters are holding 60%. You remember that? Post merger, I'll show it to you. Post merger promoters holding was 60%. Students, if post merger promoters holding is 60% of the post merged firm, do you realize the free float must be 40%? I hope you understand. So therefore I'll write down here, since promoters holding percentage is 60%, can I say free float holding percentage will be 1 minus 60%, that is 40%. Therefore the free float market cap will be, if the total company's market cap is 2001 lakh, do you realize free float market cap will be 2001 lakh into the free float holding percentage, that is 40%. If I take my calci, 2001 into 40%, if I do, 800.4 lakh becomes the free float market cap of the post merged firm. Everybody clear? Yes. So with that, students, we complete your question number 8. I hope you understood this question. I'll now flash the solution of this question on your screens. You can pause the video and copy down the notes. Thank you very much. See you in the next video with another question.